All right. I see the notice popped up saying that it was live streamed.
Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalam ala ashraf al-anbiya'i wal-mursaleen. Muhammad wa ala alihi wa ashabihi ajma'een. Amma ba'd. Ikhwat al-Islam, ibadallah. I'd like to welcome you all to another episode of Heavyweight Dialogue. And I'm your host, Najeeb Al Anjelesi. And it is hoped that the brothers and sisters that view this particular podcast, for lack of better expressions, are in the best state of health and al-Iman, or faith in Allah Tabaraka wa Ta'ala. Now, as usual, I have my regular participants, our brother Abu Abdussalam Siddiq Al-Junyani, who's currently in the room, and our brother Abu Abdullah Ismail, who will be joining us shortly, inshallah. But we have a guest participant tonight for this particular subject matter that we'll be dealing with. And as advertised, the subject matter will be encouraging economic growth, yani amongst the Muslims. And this is something that's very important because we have to translate our taqwa and our iman into action. There has to be some type of action in order for us to spread Islam and the Sunnah throughout the society that we're in. And that is as it relates to spreading it to others within the society and yani consolidating it within ourselves and our hearts, and likewise within our children as well. And so we have to deal with the reality that nothing's for free. Nothing is for free, that things cost. And in order for us to be able to deal with some of these issues, we can't ignore economics. So first and foremost, the guest participant tonight is a brother that I've known, if not for 20 years, then just about 20 years. Our brother Abu Corporate Shakir, and he's a brother from amongst the Angelesiin, meaning from amongst the brothers from Los Angeles, California. And I think that the appropriate question to be posed to him as of now would be for him to introduce himself and give the listening audience a little bit of his background. So without further ado, I'll pass the mic to the brother so he can do that, inshallah. Waffaqana Allahu wa iyyakum.
Barakallahu feek. Assalamu alaikum, everyone. My name is Abu Corporate. I'm based in Los Angeles, California. My background, prior to converting to Islam, or as some people say, reverting to Islam, I worked in corporate finance, accounting. I have a legal background, the industries, film and television, the music industry, real estate, finance, insurance. And I work with clients from large multinational companies at some of the larger accounting firms I work with. And I've worked with, smaller companies at some of the boutique consulting firms that I worked at. Areas of law include family law, business law, mergers and acquisitions, anything with capital, raising money. Used to have investment security license. And much of this was prior to converting to Islam. And so hopefully in these areas that I have experience and expertise, if questions come up in those areas, hopefully I can add value to those that are listening.
And barakallahu feek. And that's mashallah, that's a lot of accomplishments there. And so this is for the listening audience, this is the brother is giving a background so that the people can understand that whatever questions that you may have, you're dealing with somebody that's qualified to respond to them. Meaning, in other words, we just don't have any Tom, Dick, and Harry here to discuss these vital these vital affairs. But we have somebody that can give effective responses by the permission of Allah Ta'ala. So with that said, then I'm going to go into the first question. And that question being to our brother, what does it take to form a business? Now, this question is twofold. This is the first portion. What does it take to form a business? And does the nature of the business determine what type of business should be formed, regardless if it's an LLC, a partnership, or sole proprietorship, and thus forth and so on?
Okay, a very good question. During the course of the past 2 weeks, I've assisted 1, 2, 3, maybe 5 clients over the past 2 weeks with selecting or helping them to launch a new business or a new service line. So I'm going to approach it from the perspective, if somebody I've signed an engagement letter with someone and they want me to advise them. With that said, one of the first consideration are who are the parties involved? Who are going to be the owners of the business? So that's really important because that can help to determine what type of entity that a person will select. Is it one owner? Would it be multiple owners? Would it be 3 people and they're going to get outside money from investors? And so if they're going to take outside money from people that are not working in the business, that's a very huge factor. The next consideration is, where do the people live? And then where would the business be conducted? Where would the business operate? And how many states? Reason that's important is because one, for tax reasons. The next one is that many of the states, they use something called nexus, Nexus, to decide if a company or entity has to pay taxes in that state. So, and one is where the sale is going to be, if it's going to have employees, if you're going to rent. The next one is from the perspective of the owners. The question from the perspective of the owners, what do they have to lose? So if somebody owns a house, if they have a car, if they have other assets outside of this business, and the business end up getting sued and someone get a judgment against the business, what does that person or owner has that can be used to satisfy that judgment? There are some common entities that are a C corporation, very good as someone looking to raise capital if you're going to get outside money. An S corporation is really good for taxes. So then there's a limited liability company. A lot of people just say LLC. That one is sort of like a chameleon. It can take, which I explain later in our conversation, but a limited liability company that tends to be a very popular one today for a lot of really good reasons. One is that it can be taxed in various ways. It can be taxed as a C corporation, S corporation. It can be taxed as a partnership or a sole proprietor. It offers really good liability protection, which we'll come back and discuss that there's 2 types of liabilities, which one is called inside liability, the other one is called outside liability. Another one is that if it's going to be foreign money involved, so an S corporation is normally excluded because foreigners to the US cannot be an owner of an S corporation. And there's some other entities that are restricted from owning an S corporation, and there's a limit on the number of shareholders or owners you can have. So an LLC tends to be a very safe bet. So for many individuals, if they're looking to start a business, they don't have the capital to bring in an attorney or someone or an accountant or someone that can advise them specifically to their situation. for many situations, an LLC is generally a safe bet. But those are some of the factors that I take in consideration. And then the next one is, which is the second question, if I'm not mistaken. If Najeeb, if you can repeat the second part of the question, which I think was the nature of the business.
Yeah, does the nature of the business determine what type of business should be formed?
Yes, absolutely. The nature of the business, it may be something that the business in and of itself may lead to misunderstanding, litigation. And so if it's one of these type of businesses, that does matter. I just recently, one of my clients is a doctor. Something that's really big now is the corona test or the corona testing. So I got two clients, one a non-doctor client, and then I have a client that's a doctor, a physician. My non-doctor client, they're doing extremely well with, testing people for the corona test. Because the doctor is involved and the parts that relate to her license, there are certain states, she's licensed in 8 states, and different states says that a certain type of professionals have to only operate in a certain type of entity. So for example, here in California, if I'm forming a law firm, which I just recently helped an attorney to set up his legal practice, he's not allowed to use a limited liability company here in California. And so those consideration has to be taken into, so if someone's going to practice something or the business is going to be conducted requires a professional license, their licensing board may restrict the type of entity that they can conduct business in. So that is definitely an important consideration as to the nature of the business.
Well, some of the things that you said in here in your answer. I know you said that you'll come to it, but some of the different types of businesses, LLC, S Corp, C Corps, we have a lot of different people viewing, and I don't know everybody's level. I know my level. I can't speak for everybody's level. So could you just give a brief breakdown, if possible, on, okay, what is the basic understanding of an LLC, the basic understanding of an S Corp, a basic understanding of a C Corp? Because then the reason why I asked that is because those terms were incorporated within your answer. And we want to make sure that the people understand what's being said.
All right. So I think a good way to basically give a basic definition or understanding of it is comparing the entities to one another. So one form of conducting business is called a sole proprietor. So there's not anything a person has to do. So if someone wants to start, I'm gonna say a food truck. So and the reason that came to mind, I have a client yesterday that operates a barbecue food truck. He was doing it as a sole proprietor. So a sole proprietor, you can just basically get a bank account, go get your business license with whatever the local municipality that you operate in, open up here in California, you're open up a seller's permit, and you can go out and conduct business. So it doesn't require any formality. You don't have to file anything with the state in terms of permission to basically form an entity. Pretty much no cost in terms of the regards of an entity. But the drawbacks of a sole proprietor is that whatever the business does, you personally are liable for it. And so there's not a separation between the individual, the owner, and the business that he's conducting. So he doesn't have a veil, and some people call it a corporate veil, between him or her and the business that they're doing. So that means all their personal assets are liable and exposed, that if they got sued, the plaintiff that sued them, if they were able to get a judgment, that person's house, their cars, all of those things that they own in their name as an individual, it could be used to satisfy that judgment. Other drawbacks to a sole proprietorship is that it's hard for it's hard for the business to live beyond the life of the owner. So normally when that person passes away, if they want to retire, that tends to end that business. And it's difficult for them to pass it on to someone else. The general population, they use a lot of debt funding or loans. So, and unfortunately, most loans in America, someone has to pay interest or riba. But the general population, they use a lot of debt funding. Sometimes it's more difficult to secure loans for sole proprietors, so sole proprietorships. Another drawback is the taxes. So a sole proprietorship is taxed on the individual's 1040. So for those of you that may be outside of America, 1040 is the tax return form that an individual used to report the activity on a yearly basis to the IRS, and it's used to calculate the amount of taxes that person has to pay. So a sole proprietorship it's reported on a Schedule C of a person's 1040, and they end up paying something called self-employment taxes, which runs about 15%. So someone who has a sole proprietorship, whatever their net profit is, you normally time that by 15%, and as an additional tax on top of income taxes. So those are some of the drawbacks of a sole proprietorship. The advantages or the benefits of it, or the pros, is that it's really simple. You can immediately start it, and easy to get up and running. And many businesses actually start off as sole proprietorship. And then as the business get traction, as it start to generate revenues, they pull in people like me, accountants, attorneys, and then they give them advice to basically incorporate the business. So some people test the water to see if the business is viable. And then once they realize that they may have something, then they may graduate it to another entity. So anyway, the first one is a sole proprietorship. Any questions or comments on the sole proprietorship before I move to the next entity?
You have anything?
No, not necessarily on that, but I do have a question as relates to, I'm sorry, give me 1 second. I lost my train of thought. No, I do have a question as relates to S Corps when you come to that portion.
Okay, great. So the next entity is a partnership. There are different types of partnerships. There are several different types of partnership, but the two main partnerships is what is called a general partnership and a limited liability partnership. With a general, some people just say GP for short. A general partnership means that all the partners are personally liable for the debt of the partnership. So once more, a partnership is relatively easy to form. If Najeeb and I decide that we want to sell, Najeeb, what will we sell? Give me the product that we'll sell.
I mean, just books, something, books. Maybe.
Okay, books. So Najeeb and I decide that we want to sell books together. Najeeb believes that I have the gift of gab. He has the capital. He has the knowledge to pick the books out. So we agree that Najeeb would pick the books. He would put up some capital for me to get around for gas money. I would put in labor to go around and sell the books and present them. And then we'll split the profit, let's say 50-50. We have a general partnership then. We don't verbally, if Najeeb and I agree on these terms, we have a partnership. It's a good notion to reduce the partnership to writing. And also many of our agreements within the religion is really encouraged for us to reduce it to writing and get witnesses. But it's not required under American law for it to be enforceable. However, it's a very good policy is to have what is called a partnership agreement, which spells out the nature of the partnership. It's sort of, for those of you that may be familiar with corporations, the partnership agreement is sort of like the bylaws of a corporation, or those of you that may be into politics, it's like the US Constitution. It basically spells out the rights of the partnership to the partners, and it spells out the rights of the partners to one another. So A general partnership, you don't have to file anything with the state, although in some states you can file it for it to be recognized. The next business entity would be something that's called a limited partnership or a LP. With a limited partnership, you have at least one partner that's responsible for all the debt of the entity. And then the limited partners are only liable for the capital that they invested. So whatever they invested, that's their only exposure. So if you have a partner that's worth $1 million, he has a beautiful $1 million home, and you have another partner, and that person is a limited partner, and they invest 100,000. If the business doesn't go well, if it ends up in a lawsuit, that limited partner, his only exposure is the 100,000. So he does not have to worry about his $1 million home being jeopardized because he decided to invest with someone else in a limited partnership. Now, the general partner, that partner is responsible for everything. So if we're going to flip it and say the general partner owns $1 million home that's in his personal name, and the business end up with a $2 million judgment, his $1 million home can be used to satisfy that judgment. So a limited partnership, those are normally filed with the state. And that just as if you were to form a corporation or LLC or a nonprofit, that's normally filed with the state. There's another entity that is used a lot in financial planning, especially in the financial planning business circles. It's called an FLP, a family limited partnership. Some people get confused when they hear family limited partnership. It's the same as a limited partnership, but it's with family members. Incredible vehicle. I'm hoping in the future, Najeeb may grant me an opportunity to come on and just to talk about FLPs and how it can benefit Muslim families. It's great for tax savings. It's great for transferring wealth from one generation to another, but it's the same as a limited partnership, except it has family members. There's a lot of benefits to a partnership. Recently, the Biden administration is trying to pass some series of tax laws that are geared towards the very affluent and the very wealthy in our country. And one of the areas that they're attacking is partnerships, because it has so many tax advantages that you can do with partnerships, especially for very wealthy people. They can use it to basically convert what is called ordinary income, convert it into capital gain income and pay a very reduced amount of taxes on it. Whereas most of us, we tend to, I want to also explain this, and this affects the entities also. In the United States, income is normally, it takes three different attributes or three different types of income. It's regular income, or what they call ordinary income. That's normally meaning that you're trading labor to make your money. Then you have passive income. That'll be something like real estate is considered passive income. If someone has some mineral rights in an oil well or something like this, so any type of royalties, licensing fees, these things are considered passive income. It's taxed at a lower rate than ordinary income. And then capital gain income. That means that you invest into something. So extremely wealthy people, the majority of their income tend to come from capital gains income. And it's taxed at the most.
That's usually stock market, right?
Or stock market is one form of capital gain income. I'm going to word it a little bit more broader and say anytime you don't trade labor and you invest capital, and that's pretty much all you had to do, that type of income tends to be capital gain. So when your money makes money for you, that's capital gain. When your hands make money for you, that's tend to be ordinary. And so the majority of us, we're spending our time trying to trading our time or selling our time to get a dollar, and they tend to tax us at a higher rate than someone that's a billionaire, and they basically just invest and they make money for them. But through partnerships, it affords the more affluent people in our society a lot of tax advantages. And there's a lot of articles out now, if someone Google it, where Biden is trying to zero in to basically close some of those loopholes. I think someone raised their hand, or is there a question?
Yes. Assalamu alaikum.
Wa alaikum salam.
My question, first of all, sorry I'm late. I don't know how I don't know how I missed I saw it when I went back to the group. I just noticed a recent message. And
لا بأس أخي, it happens. لا بأس.
Anyway, my question was, when it comes to the kind of income that's taxed less, or at least with less, more it's taxed less than other incomes. You mentioned income that's invested. So let's say, for example, someone has a business and they want to expand their business. So they go to someone privately and they say, listen, I want to expand my business. I need $50,000 to do so. If you do so, I'll give you 10%. That person now, that $50,000 that he invested in your grocery store or your car dealership or your real estate business, he's got that $50,000 when he goes and prepares his taxes for that year. He's going to basically like mark that or put that down as invested income, and he'll be taxed less. Correct?
Okay.
Just,
the overall answer is yes. And then I just want to clarify one part. When he makes the $50,000 investment, if no money comes back to him in that same year, that $50,000 does not have to be reported in that year, because that's money going out. Now, the person he invested with in your example, that person.
One second, Abu Corporate. 1 second. Ismail, do you have this plane? If you have this plane, you need to turn the volume down. I hear an echo.
Me? No, I don't.
Somebody
I don't
has
have
to-
anything planned. I don't have anything planned.
Okay. It seems like I hear an echo what you guys are talking, but let us. I don't.
I hear
have it.
something. I hear something that you're hearing, but I don't have anything planned on my side.
I don't have anything. I don't know.
Okay, let us, inshallah. Let's keep rolling.
Okay. So in your example, I'm gonna say year one, he makes the $50,000 investment. With that, the person he invested with, I think it was a grocery store in your example.
Mhm.
So the grocery store owner, long as he does not make a payment back, the person who made the $50,000 investment in year one, that doesn't affect his tax return.
Okay.
And let's say in year two, the business does extremely well and the person pays him back. I'm not sure in your example if you're saying he's paying him 10% of the money he loaned or 10% of the profit of the business. Which one?
The profit. He basically.
Okay, so he's getting 10%.
Right.
Okay.
From now on, he says you get 15 or 10% of whatever the business makes because you helped me expand by giving me that $50,000.
Okay. When payments are starting to be paid back, then that would be the year. So you're saying year two, the grocery store starts to pay him money back. That's when he would report it on his tax return.
Okay. And he will pay less on that than someone who was
assuming he did not work in that grocery store or the entity that owned the grocery store. The answer is yes, because that would be investment income for him.
Okay.
That would be capital gains, like
Now,
you said.
I apologize. I want to correct one thing. If it's a loan, the answer would be yes. It'll pay a lower rate. However, if he's a part owner, depending on the type of ownership structure it is, his percentage of the income may be considered ordinary income because he's splitting the profits, and it may be taxed as ordinary income rate at the ordinary income rate. And that's because there's a possibility in your question that he may be a co-owner of it, and it's not the same as just trading stocks.
Gotcha.
Okay. So we discussed the sole proprietorship, and I'm doing it in a level. So like if they're teaching it sometime in some curriculum or programs, you start with the easiest one and then start working your way up to the ones that have a little bit more complexities to them. So the first one we discussed was sole proprietorship. We discussed partnership, and then we broke partnership. There's several different types of variations of partnerships, but the two main categories is a general partnership and a limited partnership. And then other partnership, I mentioned that a general partnership, you don't have to file anything with the state. Najeeb and I can just agree and move forward. I gave an example of us selling books. Then you got a limited partnership. Those are normally you file with the state for a limited partnership. Now, there's one thing that I want to mention, and I mentioned with a limited partnership that you always need a general partner. For more, I'm gonna say for more advanced structuring or corporate structuring, we sometimes we form a limited liability company and we make it the general partner, and then the natural persons or humans, in law, sometimes refer to them as natural persons. The natural persons become the limited partners. So that way, no individual is really responsible for the activity of the limit or the partnership. So in that setup I just gave, the general partner, instead of being a natural person, you can make a limited liability company, and then that natural person would be a manager of the limited liability company. And then all the natural persons that invested, they would be limited partners. So that way, no human individual is responsible for the debt of the partnership. But that's a little bit more, you're using more than one entity to accomplish your objective in that example. Any questions on partnerships? The next topic, I'm sorry.
I do have a question, because when you're dealing with limited partnership, that aspect, right? And you said that a limited partnership usually has a general partner. Because that general partner on the bar here seemed like he has more to lose. When the profit comes in, does he receive more profit as well? Does he have more to win on the flip side?
That's up for the parties to negotiate. And so the general partner, an example I gave with the LLC, the general partner may just own 1%. And so that'll be negotiations between the partners. And so the answer is that if it was a human and I was a general partner and I was going to carry more exposure than the other limited partners, then I would want a little bit more ownership for taking on that liability. However, if you have a limited partner that placed $1 million in and you really need that $1 million, that person may end up owning 60% and you may end up with 40% and you're the general partner. And then the other one, it depends on if it's people that got something to lose and they coming into your partnership, and that's going to be, it's 4 individuals that start in a partnership. All of them are millionaires. It's very unlikely that one of them is going to be the general partner, and that more likely than not, in real life, you're going to probably use another entity to be the general partner, such as a limited liability company. And then they would just become limited partners in it. So if it's 4 individuals that want to conduct business, it would probably be 5 parties to that partnership, a limited liability company to be the general partner, and then the 4 individuals would be limited partners in it. So, all right, the next entity would be, I'm gonna save limited liability companies to last, and then the next entity would be a corporation. And corporations are start at the state level, at least once more speaking from American perspective. So corporations are start with getting permission from the state, normally through something called articles of incorporation. So almost all corporations start off as C corporations. And then once a person form it at the state level, to get classified as an S corporation, you have to file something called a 2553 with the IRS and get permission from the IRS to be taxed as an S corporation. So from a tax perspective, from a legal perspective at the state level, a C corporation and S corporation are pretty much the same. They start off the same way through articles of incorporation. But an S corporation goes one step further and it asks for permission from the IRS to be taxed as an S corporation. So I'm gonna first discuss a C corporation. A C corporation the corporation is a separate entity from its owners. So the owners are called shareholders. And if the corporation, in my example, make $100,000, a C corporation, it's going to pay tax at the corporate tax rate. So it's going to prepare a corporate tax return, which is normally 1120 for the federal. And then each state has different numbers. Here in California, it's a 100, Form 100. Whatever on that 100,000 profit, it's going to pay taxes. Then when the owners take the money out to use it personally, the shareholders, they're going to also pay taxes on the money that they get from the company. So that's what they call double taxation. You pay taxes at the entity level and you pay taxes at the owner level. So, and for a corporation, let's say it's a simple C corporation, someone started a plumbing business and they conducted business through a C corporation. There are basically 4 ways they're going to pull money out of a C corporation. They're going to either pull it out through a salary, then they're going to pay payroll taxes. And it's one owner, so it's only one owner. So that one owner pulls it out through a salary, so he's going to pay he's going to pay payroll taxes, which is his money. So he's going to pay the employer side. That'll be from his ownership of the corporation. Then he's going to pay the employee side. That'll be for him being the individual under his social security number. But keep in mind, it's not someone working at Starbucks where Starbucks is paying the employer side and then the employee is paying the employee side. So basically all this is his money. So he's paying a lot more in taxes when he pays himself if he's a plumber through a C corporation. Or he's going to pull the money out through a dividend. Then the corporation is going to pay taxes on the profit. Then he's going to pay taxes on whatever money he pulled out through a dividend, which once more, he's paying more than his fair share of taxes if he's going to basically use a C corporation. Then the next way he pulls the money out is through a loan. A loan is not tax. The loan initially is not taxable. It accumulates on the books and it allows him to use it. But if he does it too long, the IRS is probably, or the tax authorities are going to probably challenge him. And the 4th way that he can pull the money out, if he put money in, he can get it as a return of the capital that he put back in, which would normally not be a taxable event. But most of us, if we start a business and we put 200,000 in, eventually we hoping it pays us a lot more back than the 200,000 we put in. So for a small mom and pop operation or a plumber that just got, he's operating himself, sometimes a C corporation doesn't make sense, mainly because of the taxes and those limited ways that he can pull money out. And only one of the ways or 2 of the ways he doesn't pay taxes. And one, which is the loan, if he does that for too long, they may challenge it and say that those are really dividends. So when people start a corporation, normally their tax advisors or what have you encourage them. I got a young lady now that's an attorney. She's been operating. She makes, more than around 200,000 a year. She hit me up to review her taxes this year. She's looking to purchase a house, and she's a non-Muslim, and she's looking to purchase a house. Her income needs to be high to qualify for the loan for the house. But with her income being high, unfortunately, she's going to, her tax bill is going to be high. Then if her income is too low, she may not qualify for the loan, or she may get it at a higher interest rate, what means she pays more money during the course of it. So she's looking for cheap income. So one of the things that I observed, her law firm is a corporation, but she did not file an S election. Her area of law is not tax law. She's not a tax accountant. She did not go through tax school. And she's good at the legal part. So she knew how to form the corporation herself. But her deficiency is that she's not versed in taxation. So she didn't realize the importance of becoming an S corporation. And so that would save her about 15%, give or take. So without her doing any other strategies, just converting. So for 2022, and she's planning to file the form 2553 to be converted. Her income is above 100,000 and it's pushing close to 200. Just that one change is going to save her $30,000, about $30,000 in her taxes. So that's some pretty real money. And if you don't pay the taxes, like when you're in business for yourself, you got to pay something called estimated taxes or quarterly. The fines and penalties that should get placed on not paying that during the course of the year, that 30,000. So it's really going to be closer to about 40,000. That just making that change is going to save her in real money. But anyway, someone may ask, why would a person, if an S corporation could save you that much in taxes, why would anyone ever be a C corporation? And the answer is there's a lot of benefits to being a C corporation, but you're saying that taxes is not the most important thing to you. So if you're saying taxes is the most important thing, you normally would elect to be taxed as an S corporation. So if you're going to be a publicly traded company, or you're going to have more than 100 investors, then you can't be an S corporation. So then you'll be a C corporation. If one of you hop on a plane, you go to Saudi Arabia, you hit it off and have some shy with one of the princes over there, and he says, great, I'd like to invest $1 million with you. You're excluded from being an S corporation then. Why? Because a foreigner cannot own an S corporation. So an S corporation has some restrictions on who can own it or what type of entity can own it. And so if you're a publicly traded company, there's a high likelihood that you're going to have more than 100 shareholders. So you're automatically excluded. Also, it's easier to raise capital normally with a C corporation than it is with an S corporation. It tends to be easier to raise capital. And once more, the people that are not working in it with a C corp, or let me word it. There are some people that have very high liquidity. C corporations have sometimes better what is called qualified retirement plans, so that you can put more money into the plan to save for your retirement. So C corporations have some advantages when it comes to retirement and how much money you can basically put in and not be taxed on those contributions you make towards your retirement plan. That C corporations sometimes have more tax advantages if you're looking at retirement plan and you got that type of liquidity. Now with a pure S corporation, an S corporation and a C corporation, those are pretty much the same creatures, except the S corporation went one step further and asked the IRS for permission to be taxed as an S corporation. And in order to grant that permission, the IRS says to get this favorable tax treatment, you're going to have to meet these conditions. You can't have more than 100 owners. You can't have foreigners that own it. Now, by you trading those things that a C corporation can do for the restrictions of an S corporation, the IRS says, we won't double tax you. So an S corporation is considered a flow-through entity. A partnership is a flow-through entity. An LLC may be a flow-through entity, but not always. An S corporation is always a flow-through entity. And what that means, all the activity of the S corporation, it flows through something called a K1, and it shows up on its owners. If it's an individual that owns it, it shows up on its 1040 tax return. At the federal level and the entity level, no taxes are paid to the IRS. All the taxes, all the income taxes are reported on the person's personal tax return or on the owner's tax return. 1 second, let me turn off an alarm.
While the brother's working his alarm, just to make a quick announcement to the listening audience, the link to the waiting room has been placed in the live chat area for those that may have questions, comments, and thus forth and so on. Then the link is in the live chat area. You can click the link now if you choose so, and you'll be entered into the waiting area. And I think this time, instead, what I'll do is, whenever it's appropriate time for a guest to answer a question, we'll just bring you in and get your question out. And then, after your question is asked, we'll remove you in order to keep the show flowing, inshallah. Now, tafadali, ya akhi.
Okay, there's a question.
Ismail, you muted. Unmute yourself.
Yes, actually, I have a quick, I just asked one quick question.
Yes.
You mentioned, when you were referring to the young lady who wants to purchase a house, you mentioned, that a person who may choose, and correct me if I misunderstood you, the person who may choose to pay their taxes yearly, a business owner who may choose to pay their taxes yearly as opposed to quarterly. You said that there's like a penalty, and
Yes. Yes. So if you're in business for yourself, someone who works at Starbucks, the government, they take the withholdings out, or they have the employer to take the withholdings out, and then they're supposed to pay that in either monthly, quarterly, depending on the size of their payroll. For someone who's in business for themselves, since they don't have someone else withholding the money from them on a W-2 or paying them, you are required to file what is called estimated taxes. So you have to figure out each quarter how much money that you made for that quarter. Normally, if you're a calendar year corporation, every 3 months, you're going to figure out what was your income. And then depending on your income, you're going to time it by whatever the tax rate for that year. And then you're going to pay that money in to the IRS. And if you underpay it, if you overpay it, then that's sort of like your refund. So like people who work a W-2 job and they get a refund back and it's not a credit, that just means they gave the government a free loan. And then that'll be sort of like your refund. If you underpaid it and you didn't underpay it by too much compared to your previous year, about 90%, if you paid at least 90% compared normally to your previous year, you normally won't get a penalty. And then if you wait to the end of the year or the last quarter, the fourth quarter, and you make all your payments then they're going to go back and say, if you're in, they would assume that your income is equally earned over the 4 quarters. And then for the first 3, they may charge you an underpayment penalty. And then even though you paid all the money within that year, you then break it down per quarter as they would like for you to do. I'm sorry, we can't hear you.
Yourself.
You're mute.
Unmute yourself.
the host muted you. I don't know why. Okay.
You know, I muted you. The feedback that I'm hearing didn't start until you came in. That's why Sadiq was muted too. So both of y'all were muted while he was talking.
Is it coming from me? Determined that it's coming from me?
Yeah, it's because when I muted you, I stopped hearing it. I'm not sure if you don't have volume turned up on a stream going. There has to be some type of technical issue.
All right.
We have to check for that later though. So
all right, I'll move. Maybe it's my position, but just the second part of my question is this penalty. It doesn't make a difference if you're LLC, S corp, C corp. That's all the same. The government is still going to deal with you the same way if you choose to pay your taxes all at the end of the year if you're a business owner, as opposed to quarterly, right?
Yeah, it does make a difference what type of entity. But to answer to your question, if you make income and you're in business for yourself, you're expected to make estimated payment. Now, the difference on the entity, if it's a C corporation, as we mentioned, it won't be you as the owner making those estimated payment. It'll be the C corporation making them, right? Because it has to report the income. If it's an S corporation, then the answer is it would be the individual, because we mentioned that it's a flow through and through something called a K1. It's going to show up on your personal, so you'll make it. If it's an LLC, which we haven't discussed yet, it depends how it's taxed. And then if it's a partnership, then the answer is it gets something called a K1 too. It's a flow through entity. So it would be the owners, not the partnership itself, but it would be the owners that would have to pay their estimated taxes on that income.
Okay.
Yeah. Quick question. As
Yes.
relates to the S corporations, I have a family member that works in real estate, or that's in real estate, and they were told that in Nevada, it's better for them to form an S corporation or a S corporation when it comes to dealing in real estate. So that's buying, selling, and renting out properties. Now, is this because of the tax advantages that they may receive? And is this something that is specific to Nevada, or is this every state?
All right. Generally, you in general, I'm gonna give an actual a tax matter that was presented to me. I have a person in a major city here in California. They own I apologize, not a major, a very a vacation destination city here in California. They own one of the most prestigious hotels in that city. They owned it for multiple years, and they sold it a while back. When they sold it, prior to them selling it, their tax accountant at the time advised them to put the hotel and own it in an S corporation. Fast forward, they did something called a 1031 exchange. So for those of you that are not familiar with 1031 exchange, it means if you sell one property, you purchase another property at equal or higher price, you don't have to pay taxes on the gain, and you get to defer it. It gets to roll forward. So that's pretty much the summary of a 1031 exchange. So they did a 1031 exchange, and they bought 3 other properties. Fast forward, the 2 owners want to separate. So this is the question that came to me. How can we separate to now without disrupting the 1031 exchange, and they own it in an S corporation? There's very few options that I could come up with. I came up with 3. Their accountant apparently didn't come up with any. I came up with 3. But the problem is that they own real estate in an S corporation. For most people, unless there's a specific objective they're trying to accomplish, as a general rule, you want to avoid owning real estate in a C corporation and an S corporation, because those are the least favorable. The reason that this person think that this is smart was advised them to do it. So there's a few states that don't have income taxes. Nevada does not have personal income taxes as of now. Texas does not have personal income taxes. So the person who advised them that, they think that because if it doesn't have to pay taxes at the entity level, and then it flows down to them on the K1, and so it's trying to get them out of state taxes, it would normally create another problem for them in terms of federal by owning the real estate. There's a real estate is, so normally an LLC would be a better entity to achieve their objective. And then it depends if they work related to the real estate, if they're a real estate professional, or they just an investor. Because the attribute of real estate is passive income. It normally would keep that attribute if you put it in an LLC. So many people who own real estate and flip it, you'll find that a lot of them use LLCs to do it. There's some risks that you can run where real estate can be taxed at a very high rate. And then it depends if it's someone's personal home or what have you. So it depends if it's just investment properties or what have you. But as a general rule, you try to do it. But when I gave him the solution, and in my example, the solution was don't take the properties out of the LLC. Once I interviewed him, his partner and him, they're not fighting with each other. She doesn't like one of the properties that they got. He agreed to take that property. So I told him to create a Chinese wall, do a contract with each other. She takes one property, which he was happy. He'll take the other one. And then the third property, they're going to split 50-50. They're going to do contracts, and it's going to state one person is 80, the other one is 70. So when he dies, that's when they're going to separate the properties. He's going to leave it to his brother. There's something when you die in the United States, property, it gets the basis of the property, it gets adjusted up to the value of the owner's death. So that when his brother gets the property, he sell it, it'll be no capital gains. It's under 11.7 million, so they don't have to pay estate taxes. So if they take it out, they're going to trigger taxes. If they keep it in till the person 70 or 80 die, and more likely it's an 80-year-old male, he may precede the 70-year-old female. That'll be the triggering event for them to separate from each other. So on the solution I gave them, the next question is, I strongly encourage you to get your current tax accountant to take care of this because it's easy to do. But I want to know, was he the one that advised you to put this in an S corporation? If he would have said yes to that, I would have told him to fire that accountant and enroll with me or another accountant. That accountant they let go 3 years ago. Just as I'm saying this, many other people said that it was a major major mistake for him to advise them to put that hotel in an S corporation. The new accountant was not a party to that transaction, so I recommended for him to keep him, and I didn't try to, steal the guy away from the other accountant. Anyway, the reason that they advised that is because probably they're thinking of the state level that there's no income taxes, and that by the K-1 flowing there, but there's some other issues that they should take in consideration. So an LLC would be a safer way to probably achieve the same benefit that they had in mind when they made that recommendation.
Right. No.
Yeah.
Jazakallah khair.
Wayak. Any other questions about what we have discussed so far?
No, I don't know if Ismail has a question.
You're muted again.
Yeah, I can hear.
Yes.
I'm trying to see if the feedback. Hopefully, the feedback went away now.
I feel like, hold on, I'm sorry. Let me say one thing. I feel like I should stage some books behind me. I noticed each one of you now got books behind you. So I feel I'm feeling a little book inadequate, So next time I'm gonna have to stage a little better.
No.
So my question was, in an event that and this goes back to my previous question regarding the penalties for the people who delay the filing of their taxes. What kind of penalties are the penalties? Are there any way around the penalties, or are they severe? Like, on average, what's the percentage the person is looking at when it comes to paying these penalties for not filing quarterly?
All right, so I prepared tax returns. As a general rule, I don't normally calculate the penalty and put on the tax. They have a form that is used to calculate the penalties. Right now, the software mostly do it for me. I used to do it back in the days when I first started taxes. Now I just let the software do it, but I deliberately tell the software not to calculate it, and then send the tax return in just based on the income taxes, and then let them send the person a bill. If it seems like it went too high, then I calculate it to see. I have found there's been many incidents where if I don't show the penalties and stuff on the actual tax return, for some reason, it falls through the cracks. But I do believe that if the penalties are showed on the face of the tax return when you file it, that it definitely would be charged. So either way, I encourage the person to just normally wait to see if they're going to send a bill. Pay the taxes. So if the taxes are $10,000, pay that. And then see if they're going to send you a bill saying that you owe more, and then immediately take care of it. That's my personal. I get some clients that, Darwin, I want to stop the interest from accruing. And I'm like, okay, well, then we won't calculate it. And then we just send in an extra 2 Gs. So 10 in your 10,000 plus 2 Gs. And then whatever they don't use, they accredit it to your, the following year. But the answer is, if it's specific numbers, then there's a form. I think it's 2220. I think it's the form. I got another computer here. I can look it up really quick if you really need that information. But there's a form that if you go through the worksheet, it'll calculate the penalties for you and let you know that if you follow the worksheet. And for most of you, majority of, at least American tax returns for most individuals, is based on about. Reports a strange activity in the area. I don't know what. I'm sorry. It's based on about maybe 9th grade math, maybe 10th at the most, 10th grade math at the most. And so the math is normally not very complicated. So it's more, taxes are more law applied to numbers, or tax law applied to numbers. I got someone that now I'm training to do taxes, and they don't like numbers. And so they act as if it's like trigonometry or something. And I'm like, it's just basically 8th to 10th grade math that with a little legal, but they interested in law, but not numbers for some reason. And so the software today for most preparers, the tax, especially if it's, for consumers, they have TurboTax and these other type of programs. For professional tax preparer, there's software that is a little bit more advanced, I think, than TurboTax. And most of that does a really good job of calculating all that for you today.
Okay.
Yeah. Quick question as it relates
and
to.
then I want to apologize. The second question is that if they send you a bill and they charge you a penalty, the other question was, is there a way to get around it? I believe that many things are negotiable in life, that you can negotiate many things, and including sometimes the taxes and stuff with the IRS. And so they have something that's called an abatement. So their terminology when they forgive you of it is called abatement. And so if it's a small amount, you may get the agent on the phone and ask them to abate it. I've had people to get penalties abated up to like $4,000, and I have called in the request for clients. I've got about 3,000 just over the phone without sending a letter. Sometime if it's larger amounts that you're trying to get abated, they may ask you to send in a letter. Most of the time, you need to offer some type of reason. Today, a lot of people are riding the coronavirus excuse wave. And so you may want to jump on that and surf it. And like coronavirus, it affected not to tell you to lie, nothing like that. I wouldn't say that, but that has been an excuse that a lot of people have used today, and it seemed to have been accepted. All right. But anyway, the process would be through their abatement process. And sometimes it's just verbal on the phone, and other times they may ask you to send in a letter with the request.
Right. Quick question with regards to filing taxes, and this is particularly for people who have either a side hustle or they're still growing their business while they're working somewhere else. Is it better for them to file their taxes along with their personal taxes or separately? Meaning their business taxes. Should they file them with their personal or separately?
So the answer depends on how's their business structured. So those entities we mentioned, if it's a sole proprietor, they don't have a choice. It has to be filed at the time of their personal taxes because it's going to show up on their 1040, which is the U.S. tax return, the federal tax return. It's a 1040, and it's going to be a Schedule C on a 1040. So they don't have a choice. It has to be filed together.
Okay.
Now they may have to segregate the income, and if a person has a plumbing business, but they also own a food truck, and then they do hair, they have 3 Schedule Cs, and they won't combine those into one Schedule C. So each one, they would prepare the income statement and the Schedule C per business, and then file 3 Schedule Cs. So the answer, if they have a C corporation, the answer is the C corporation normally would not impact their personal tax return. So they can file a personal tax return without having the C corporation done, or vice versa. They can prepare a C corporation tax return without having a personal. Now, if they have an S corporation, what's the reason they can't file their personal tax return before the S corporation? That's a question to the group. We sort of discussed that earlier. What's the reason a person could, to answer your question, I'm answering it with a question with an S corporation.
Right.
What is the reason that a person cannot file their personal tax return if they conduct a business through an S corporation before the S corporation is prepared? What's the reason?
You said before it's prepared?
Before, so your question was, can they do it separately, or do they have to do it together, right?
Right.
So with an S corporation, if they conduct a business through an S corporation, my question to you, why can they not file a personal tax return before the S corporation is prepared?
Because they have to have the what's the word I'm looking for? Because they have to have permission from the IRS to file with that.
No, I thought
that, is that it?
I was hoping. The reason is that the S corporation is a flow-through entity. So all the activity flows from the S corporation to their personal tax return. If they file their personal tax return before preparing the S corporation tax return, they would omit all that activity. So there's something called a K1 that connects the owner, at least in terms of taxes, that connect the owner to the S corporation. And all the activity is going to end up on their personal tax return. But if they file their personal tax return before preparing the S corporation tax return, they would exclude all of that from their income. And then they would probably have to amend a personal after the S is completed, because that K1 would end up getting reported to the government.
Right.
So the answer to yes.
I'm just going to say, so is it similar to them getting taxed twice unnecessarily?
No, not with an S corporation. Not with an S corporation. The federal one is not taxed. It's not taxed at the federal level. And so there's no income taxes for an S corporation at the federal level. That's the very reason that most people make the S election.
Right.
You know, I mean,
to avoid double taxation.
I mean, when they get it amended, is it gonna feel like they got taxed twice if they have to make
No.
Okay.
No. It just mean that they forgot to report. So the S corporation could have had a loss. So they could be losing a benefit, or if it had a profit, they're just going to pay tax. If they already had filed it and paid taxes already, when they amend it, they're only going to pay on the part that's related to the S corporation. The drawback is that they're going to probably end up paying a tax preparer twice to basically amend the tax return. Whereas if they waited, they only have to pay one time for their tax return to be prepared and filed.
Gotcha.
Right. But now, how would that apply in a state like Florida, for example, that has no state tax?
Yeah, it's the Florida. By the way, in Florida, you don't even have to file it. If it's an S corporation, you don't have to file a tax return, mainly for that reason. But that just means you don't pay state taxes, but you still have to pay federal taxes.
Right.
Because you still have to file your 1040 with the federal. So people in Florida, they still pay income taxes to the federal government. They just don't pay any income taxes to the state government.
On the state government, right? But with the S corp, that is to try to avoid the state tax, correct?
No. The S corporation is to avoid. Normally, it's to avoid double taxation, both federal and state.
Okay.
My state, we have taxes. So if you have a C corporation in California, you're going to pay federal taxes at the entity level, and you're going to pay California taxes at the entity level. And then if you get a dividend, you're going to pay federal taxes on your personal tax return at the federal level, and you're going to pay, state taxes on the personal. So you're going to pay 4 times if you live in California.
Gotcha.
Whereas if you have an S corporation, you're only going to pay twice. You're going to pay the federal government on your personal tax return, and you're going to pay the state of California. If you live in Florida, Texas, Nevada, you're only going to pay once. That'll be to the federal government. Yeah. So the main reason for it is to get out of federal taxes.
Okay.
Double taxation. That's one of the main reasons to make the S election.
Gotcha.
Yeah. All right. The other entity that we have not discussed is a limited liability company. A limited liability company, the reason I held it to last is that I can make a reference to the other entities in order to be able to explain it. So a limited liability company, once more, just like a corporation, it started at the state level. And so it starts off through something normally that's in most states, it starts off with something called articles of organization. If it's articles of incorporation, if you hear that, you associate that to a corporation. If you hear articles of organization, you normally associate that to an LLC or a limited liability company. With a limited liability company, it can be taxed depending on the number of owners. It can be taxed if it's a single owner or a sole member, it can be taxed 3 different ways. If it has 2 or more members, it can be taxed also 3 different ways. So we're going to first deal with the situation if it's only one owner or sole owner LLC or a single member LLC. It can be taxed as a sole proprietor, the same as someone who don't form an entity. If you form an LLC and you don't do anything to it and you're only one owner, that's going to be the default treatment of it. It's going to be taxed as a sole proprietorship. So you're still going to pay self-employment taxes. Or you can make an election to be taxed as a C corporation. That normally doesn't make sense for most people. So you rarely see that happening. Or you can make an election for it to be taxed as an S corporation. And so then it's identical from a tax perspective as the S corporation we discussed earlier. So either it's going to be a sole proprietor, which we already discussed, it's going to be a C corporation, what we have already discussed, or it's going to be taxed as an S corporation. So it's really like a chameleon that it can just take the color of each of the other entities depending on what election, how many owners and then what election you make after you form it. If it's 2 or more members, the default treatment of it is taxed as a partnership, what we have already discussed. So it'll be taxed the same as a partnership. Or you can make an election for it to be taxed as a C corporation, which we have discussed, or you can make an election for it to be taxed as an S corporation. So if it's a single member LLC, the default of it, treatment of it in terms of taxes is a sole proprietorship. If it's in 2 or more members, the default is that it's a partnership. Now, I'm going to present a question. Why would one form an LLC and elect for it to be taxed as an S corporation versus just forming a straight S corporation? The answer is that, one of the answers is that an LLC, with an LLC, it has sometimes less requirements in order to keep the corporate veil. So when you form a corporation, you get something called corporate veil. That means it protects your personal assets from the business. But with a corporation, you have to meet annually. So you have to have at least a shareholders meeting, and you have to have a board of directors meeting. An LLC, you don't have to do that. A person got to be almost a complete slacker in order to mess up an LLC. Whereas an S corporation, a straight corporation taxed as an S corporation, if you neglect to basically keep your corporate minutes, you neglect your board meetings, they may say it's your alter ego, that you're not running this corporation like a real corporation. And then at the time that you really need it, that one of your workers slammed into the back of someone's car, did not have insurance on it, and they see that they were conducting business for your corporation. If your corporate veil is there, it's very unlikely that your personal house would be exposed. If the corporate veil can be pierced, think of it like a hijab, and that it covers the whole corporation. But each time you get a hole in it, that means someone can reach through and basically get some of your personal assets. An LLC, very difficult to do, very difficult. There's no annual meetings required unless you decide that you want to meet. A corporation, in many states, there are minimal number of officers that have to be. So in a corporation, I want to give the anatomy of a corporation, or a typical corporation. And I'm going to use my state as the basis, and most states are similar. In California, if you form a corporation, you got to have a minimum of 3 officers. And that you have a shareholder, which is the owner. You have a board of directors. Then you have officers that basically handle the day-to-day affairs of the corporation. So you got to have a minimum of 3 officers in California. And those 3 officers is a CEO, CFO or treasurer, and a corporate secretary. An LLC, you don't need any of that. And so once you form it, you can basically place it on cruise control, and you don't have to do a bunch of formalities after you form it. Or you can have as much formalities as you like or need. And so that's the reason that some people form a limited liability company and then elect for it to be taxed as an S corporation, because the annual maintenance of it tends to be a little easier than a corporation, and mainly because you don't have to do those meetings and resolutions and what have you. And you don't have to have the officers and board members and all that stuff. So an LLC, that's the entity that can take the attributes of each of the other tax entities that we discussed. And then one of the things I want to mention on the LLC, limited liability company. A limited liability company in many states don't require something called an operating agreement, but it's a good policy to form it. So I get a lot of people, they have formed an LLC themselves. In many states, it only takes one document to form to form an LLC. And once they form it, they run off and start opening up their bank account, and they look and they said, $9.99, Darwin, I didn't need to pay an attorney. I didn't need to get someone like you. I didn't need to get an accountant. I did this myself. I got me an LLC. All LLCs are not equal. All LLCs are not equal. And so one with a very strong operating agreement can be more valuable than an LLC that someone formed by just filing the articles of organization. And LLCs have something that they call, in many of these entities, you're trying to figure out, how to minimize liability, your exposure. And so there's something called outside liability and then something called inside liability. And I'm going to give an example of each one. Most people think of a corporation protecting outside liability, meaning that if you own a trucking company, one of your drivers have an accident, they call someone to be a quadriplegic. You've been operating a trucking company for 20 years. You own a lot of money. You've been moving the profits out of the corporation, all the cash into your personal bank account. You own a mansion. You got a Ferrari, Lamborghini, and you got all these semi trucks that are owned through the corporation. And then the Lamborghinis and your house is only in your personal name. One of your drivers mess around and slam into the back of a car, call someone to be a quadriplegic. Turns out you had a lapse. Your bookkeeper didn't make your premium on the insurance policy. No insurance to cover this accident. You don't have your $1 million policy in place. So that's where your corporation would kick in and help and save you if you took care of it through the years. So when they go to sue, you can, hopefully your corporate veil will protect you so they don't get your personal house, and they can only get the other trucks and stuff in the corporation. That's called outside liability that you're trying to protect. Inside liability is when you're trying to protect the corporation from the actions of its owner. An example, in that same scenario, it wasn't the driver that had an accident that caused the lawsuit. The owner of the corporation went out to a sporting event, and while he was at the soccer game, he got a little too excited. And somebody started bad-mouthing his son, and he socked the person and basically messed up their face, and they need a bunch of plastic surgery, what have you. And it turns out it was a model. And that person claimed they lost income. So they get a $500,000 judgment. That's where the corporation is weak at. So once they get that judgment against the owner in his individual name, all the things that he owned can be used to satisfy that judgment. Guess what? He owns his corporation in his individual name. And so what that $500,000 judgment, his shares of stock that he owns, his trucking company, can be used to satisfy that. His house that is in his individual name can be used to satisfy that. That model, they were driving a Honda Accord, which is a very nice car, by the way. But guess what? They just upgraded. They now driving that Lamborghini that belonged to the trucker. That's called inside liability, meaning what is going to protect the owner? What is going to protect from the actions of the owner, the individual? That's when an LLC is superior to a corporation. There's something that you can place in an LLC, a poison pill called a charging order. So you can place things in an LLC to discourage someone from taking the ownership. And you can write the operating agreement where the five of us that's on this call, we form a limited liability company. We bang out a beautiful operating agreement and we put a charging order in it. Then we put something else in it that all the current members have to agree for any new member to be admitted as an owner. So Najeeb, I'm going to pick on you. Najeeb gets a $100,000 judgment against him. That person wants to satisfy, Najeeb's sole source of income comes from this limited liability company. They now want to take Najeeb's ownership to satisfy this $100,000 judgment. If we got a properly written operating agreement, we can help Najeeb out. The rest of the four of us, we got paper. We got other sources of income. We got real estate. We don't need the income from this LLC. We don't need the cash from the LLC, let me say. So this is how we can help Najeeb. First of all, if we got to prove anyone else being a member, it doesn't matter what Najeeb did, they can't come into the membership and take his owner. They can't become members. The other thing with the charging order, we can decide to change the percentage of profit. We're going to give Najeeb 100% of the profit. We agree as a group that Najeeb get 100% of the profit. You may ask, Darwin, why would you do that? Someone is trying to sue Najeeb to get his ownership and to get his income and his cash. Why would we agree to give Najeeb 100% of the profits? Here's the reason. Najeeb, if they try to take Najeeb's position and get assigned Najeeb's income from the LLC, we can give them the income without giving them the cash. Cash and income are two different accounting concepts. Cash and income are not the same. Everybody with that, right?
Mm-hmm.
Or does that need to be explained?
Understand.
How it's understood that cash and income are not the same thing. Okay, awesome. So how would you feel if you're a creditor, you sued Najeeb, got a judgment against him, then you get $100,000 of income assigned to you, but the LLC refused to pay out cash. It doesn't do a disbursement. You're paying taxes now as a creditor. You're supposed to be collecting money. You're now paying taxes on Najeeb $100,000 of income. How many creditors you think would want to pay for Najeeb's income? None.
None. Yeah.
That discourages a creditor from taking Najeeb's ownership. Because the main reason is that we can change the ownership percentages let me word it about, we can change the profit percentage, and cash and income are not the same thing. And because of that, we can give them the income and we can hold the cash, and keep in mind, the rest of us, we don't need it because we got other sources of income.
Right.
We're doing this to help our brother Najeeb out. So that's sometimes why some people choose an LLC and then elect for it to be taxed as an S corporation versus a straight C corporation, and then convert it to an S. Low annual maintenance, and because if you write a brilliant operating agreement, you can use it for so many different things.
No.
Any questions?
Yeah, I have two. And so the first one, in a situation where someone is awarded an income, like the example you gave with Najeeb, what would that consist of? Does that mean what that person, if it's $100,000 worth of income, that's what that person can potentially make moving forward, or how does that? What will be?
No. This will be passed. I mean, it's saying that the LLC earned, let's say the LLC earned a total of $100,000 income.
Okay.
Before Najeeb got sued, we were splitting it 5 ways: 20%, 20%, 20%. Right? Najeeb gets sued. We come together as a group and we want to help Najeeb out to discourage his creditor. If they somehow figure out how to get his ownership, we want to discourage them so that the ownership is not. So we as a group, in a limited liability company, right, you have 3 percentages. You have an ownership percentage, you have a loss percentage, and you have a profit percentage. Those 3 don't have to match up. An S corporation, you have 1 percentage. Your ownership percentage is the same as your loss percentage, which is the same as your profit percentage. It's the same. An LLC, not the same. An ownership percentage, a loss percentage, and a profit percentage. And those 3 you can change up as often as you like among yourselves as an agreements. And so we can keep the ownership percentage at 1%, let's say, whereas the profit percentage can be 90% for a member. And because of that play, and we decide as a group we get to do that, we know that we're going to try to strangle this creditor out. So we're going to assign him income, all the income, which help us on our taxes now, but we're not going to give him the cash to pay the taxes on that income. So he gets $100,000 of income, but we keep the $100,000 cash in the bank account of the LLC. And we got other sources of money. So we can go 3 years. Most creditors are not going to want that. They're not suing Najeeb so they can pay his tax bill. That's called a charging order. So if an operating agreement has a charging order, it tends to discourage a creditor.
So will they still get, you said, when you say, I'm getting confused when you say we're going to keep the cash. So we'll have $100,000 of actual cash in our bank, for example. And they're getting...
We keep it until the creditor gives up.
We keep it till he gives up. Okay.
We don't pay it out until the creditor gives up.
Got you. In the meantime, he's getting taxed on that.
The creditor is if he took Najeeb's position as a member.
Got you.
Correct.
Understand. Okay. So my other question is, what are some examples, like someone, for example, who owns an LLC?
But let me just say one thing. that is a very unlikely scenario to happen.
Yeah.
Many creditors
Sounds
are
good.
aware, and if an operating agreement has a charging order, many of them understand that means that we can play these games with them. And it's not too much they can do about it, at least in terms of the LOC.
Okay.
Okay,
My
now
que-
your question.
My question is, so in the case of an LLC, and I guess this can be applied to S Corp, C Corp too, but in the case of an LLC, what are some typical things that people should be aware of when it comes to, what they can write off and what they can't write off, some misconceptions, and what are some things that people tend to overlook when it comes to writing things off? Like, because I know sometimes people may say, okay, in the trucking business, for example, they say, okay, your gas prices, whatever you have to pay employees, maintenance, things like that. Are there any things that people typically tend to overlook that they should look out for and that they have the ability to write off, but they're not aware of it? And what are things that just like pretty much a standard everybody should know?
Okay, as a rule of thumb, anytime you spend money to make money, assume that you can write it off.
Okay.
So you as the business owner, assume anytime you spend $1 to make $1, assume that you can write that off. And then let your tax preparer put the brakes on. So your job as the owner is to assume you can write off everything. And then let your tax preparer be the one to say, no, if you got a qualified tax preparer, let him be the one to say, no, I'm sorry, you can't write this off. Now I want to give a couple of examples. When it comes to, I'm in business for myself. I have a consulting business, and then I co-run a law firm with a business partner of mine in another business I do. I assume I can write everything off. And then there's a few exceptions. So if I was an actor, I'm in a city that has a lot of people that work in film and TV. So there are specific things like I can't write off my dry cleaning, but yet I feel like I just can't show up at a meeting in a t-shirt. And so I feel that I should be able to, I only do dry cleaning to have a nice shirt so that I can go to meetings and meet with clients, right? And so I should be able to write that off. However, there's a specific tax rule. So my general rule, I assume I can write off everything unless there's a specific exception to that general rule. So anytime I spend money to make $1, I'm trying to write that off. Now there's a specific rule that says I cannot write off my dry cleaning. So they got a specific thing that said that Darwin Troop cannot write off his dry cleaning. So my dry cleaning now, I don't even worry about those receipts now. There's no way I can wiggle around that. Now, there are certain people that can wiggle around that. So if you work at a mechanic shop and you decide to put the name of the shop on it, so that's one of the exceptions. If it's a uniform, you can write the uniform off. So nurses can write off their dry cleaning for their uniforms, not for when they go out to the beach, okay? A mechanic, if he puts his name on it, he can write off his uniforms, his dry cleaning, he can write off the purchase. Now, if I really want to write off my dry cleaning, I would put the name of my business on my shirt and call it a uniform. However, I don't want my name of my business on my shirts. I think they look nicer without my name on them. So I have not went to that extent to try to qualify my dry cleaning so that I can write it off, and I just take the L on that. So the general rule is always assume that you can write it off, and then let your accountant put on the brakes for you.
Let me ask you a quick question as relates to that. Now, what about just the initial purchasing of whatever clothes that are going to specifically use for that job? Is that something that you can write off?
The way you worded it, it makes me really want to say yes. However, are you talking? If I buy a specific suit for an event, if I can wear that, even if I choose not to wear it again to any other event, the fact that I can wear it to a future event, that excludes me from being able to write it off. Now, if I get invited to a red carpet event and one of my clients, have some type of movie premiere or something, and I rent a tux for that, I can write the tux off. If I purchase the tux, I cannot, because I can wear it for future events. But if I rent it for that specific event, then I can write off the rental of the tux. So in that case, it may be smarter for me just to rent the tux as opposed to purchasing it. But the answer is if you can wear it to something else and it doesn't have the name of the business on it, as a general rule, you cannot write it. You cannot write it off.
Okay.
So when you the things that can be, are they such, like when you write something off, right? Are there any cases where you write something off and you only get like a partial break, or is everything that's written off completely non-taxable?
So I want to change some concepts. So when you write something off, it's reducing your income dollar for dollar. If it's a business deduction, it's reducing your income dollar for dollar. Now, you're getting audited. It's a separate event of you writing stuff off sometimes. So there's a lot of reasons a tax return get audited, a lot of reasons. Okay. Now, if you get audited, so you notice when you file your taxes, you don't have to send in receipts at the time you file your taxes. And it's an honor system. So they trust whatever numbers that you put on your tax return, that those are your legit numbers, right? So you don't have to send in proof. So if you're saying that you spent, I'm gonna make up $5,000 on gas, you don't have to send in all those receipts. You don't have to send in your debit card statements or what have you. They trust you and say, okay, then if you get flagged to get audited for any other reasons that a tax return may get audited, and sometimes it's no reason, it's just to keep people on their toes. Right. But let's say you get audited. If you can't produce receipts, then they may back it out. I handle quite a bit of IRS audits, and sometimes it's just negotiating. Like this morning, I got a client that I'm negotiating on. They claim that she owes, she started out on 2.4, we got it down to 700,000. They tried to sell this person's house. Another accountant screwed her up. I'm trying to fix her up, and we're negotiating now. And so the IRS look like they're trying to win on the technicality. And she waited too long. They have a statute of limitations. She didn't wait long enough to appeal the audit. She waited too long, I should say. And so based on that, I think I have a strategy. If we go to court, they have about, give or take, they have about a year. If they don't collect the money in a year, so the IRS has a rule that if they don't collect the money in 10 years and they know that you owe it, you're not, you didn't hide the fact that you owe them taxes. If they don't collect it in 10 years, on 10 year and the next day, you can tell them get lost. That money they can't collect then. This individual, we're close to running on the statute, close. But we have to about October of next year. So that's a long time to try to drag this thing out. So they're trying to make a move on their house, on my client's house. So I think I have a strategy, but it's an experimental strategy that the IRS feels strongly that I'm bluffing, but they believe enough that they're willing to negotiate, even though they feel they got a technicality win. And so as of now, we got on the table the 700. We got on the table. If this client can come up with about 136,000 and drop that cash to the IRS, they said they'll let the rest go uncollectible and it would fall off when the statute runs. I think it's a brilliant deal. My client, unfortunately, they having some liquidity issues at the moment, and they, we pull some incredible moves that have got them this far, and they keep thinking that I may be some type of genie and can keep pulling moves out the box. Whereas I'm like, sometime when you win and you go beyond, you may end up losing everything. So I'm like, okay, we don't want enough. Let's stop and just see if we can figure out how you're gonna get this money. But anyway, to answer your question, with deductions and stuff like this, and the reason I gave that example of this client is that even on these larger amounts, you're dealing with humans and stuff on the other side. And a lot of times you can negotiate. If I'm in an audit, I try to build a report. If I know that your stuff, you don't have receipts and stuff, if I was doing an audit, I try to build a report with the agent. If I know that I got numbers on my side, I got receipts, I got the law on my side, I don't need to build a report with the agent. Like, dude, get lost, bro. I don't care. Because I know that I can prove it. So the law is on my side, the numbers on my side, I don't need to kiss up. If the numbers are not on my side or the law not on my side, then I'm doing my best to try to figure this auditor out, build a rapport with them, you know, and negotiate, or come up with some other strategy. I would may get me in trouble, so I won't share this one. But anyway, my point is expenses and stuff like that. If you don't have receipts, sometimes it doesn't mean you still. I used to give people an example. If you're riding the public transportation, you had all your receipts, legitimate receipts. You have a 1099 that you made 300,000. You have receipts of 250,000. So that means when your accountant prepares your tax return, you're only going to pay taxes on 50,000, right? You're on a bus. You on your way to your tax preparer's office. You got all your receipts in the bag. And while you're on the bus catches fire. You're more concerned about saving your life. You jump out the window and totally forget to grab your bag of receipts. You save your life, keep on to your tax accountant office, and you tell them, hey, I was coming down, the bus caught a fire. I left all my receipts on the bus. They all got burnt up, and I paid for everything in cash, so I can't get my bank statements run through. I can't get credit card statements, and I didn't have it digitized. Man, I got to pay taxes on the 300,000. Answer is absolutely not. What your accountant should do then is say, we're going to create a spreadsheet. We're going to look at your previous year, and we're going to do our best to estimate and we're going to estimate the categories. Now, here's the problem. If you know for certain that all your receipts total 250,000, but when you and your accountant estimate and you put 275, you're lying now by 275. That 25,000, you're lying by 25,000. That 25,000, that part now it would be illegal. But the 250, because you knew that you just don't remember all the categories. And then you submit that tax return on 250. And then if they challenge it now, that your accountant should explain to you that if you can't prove the receipts, there's a high chance that the auditor may bag these out, that we can't. You're not a Wesley Snipes, though. Meaning that it's not a tax crime. It's not tax evasion. Right. You weren't trying to defraud. You had legitimate expenses. You know you spent the money. You just lost your receipts, and you had to do your best to estimate the categories. All right. Does that help you out?
It helps me out a lot. So things like, for example, paying salaries to your employees, all of that's going to fall into the same category. You're not getting taxed on it.
Or I'm going to word it another way, because there's a reason I'm not saying it that way. It reduces your taxable income dollar for dollar.
Reduces your, that's what I meant to say.
Dollar for dollar.
Reduces your
dollar for dollar.
Dollar for dollar. Okay.
Yes.
All right, that's what I did. Reduces your tax.
Sounds like he needs to hook up a private session, huh?
No. Hopefully there's people that can benefit from the questions. All right, so I want to throw out a couple other things on entities before we move on to, I guess, if there's any other topic. There are some other business entities that are not as commonly discussed. So there's trust. There's business trust that you can set up, different type of trust that you can use in business. Many of the trusts, you don't need permission from the state. So if you're going to set up a corporation, there's normally some type of statutory law that allows you to form a corporation, and that's at the state level. A trust, that's normally like a contract that you don't have to file with the state. And there are so many trusts, and they can be used for so many different purposes. And then there's something, so there's the trust that can be used, which a lot of people don't use them as much. Real estate is a perfect example, like that hotel that I mentioned, that I'm helping this guy out that owned the hotel. If their accountant or whoever, when they bought the hotel, if they would advise them to put it in a land trust, that would help them tremendously today. If they would have purchased a hotel and put it in a land trust. One of the most famous use of a land trust, if I'm not mistaken, our brother lives, one of our brothers, I think, is from Orlando, Florida. He has Disney World. Where I'm at, we have Disneyland, which I think started first. But they got the bigger one, Disney World in Orlando, Florida. My understanding is that to prevent landowners from jacking up the price. Can you imagine if they knew Walt Disney Company was going to come up there and buy all that land and they're trying to consolidate that, how much the prices would have went up for the last piece of land that they wanted? Like, I'm telling you, if I had that last piece of land and I knew Walt Disney Company was going to need it to basically build Disney World, man, I would have been like, you got to give me like 25 times the amount. To keep the identity concealed, my understanding is that they used a land trust. So nobody knew who was buying up all that land until they secured it. And so there's something with a land trust that you never have to change. The land trust that many people use today is called an Illinois land trust. And I think Illinois may have been the first use of it. And then there's another trust that's called a Michigan Business Trust. But the beautiful thing about an Illinois land trust is that you can separate equitable title from legal title, meaning that the trust has title to it and that the beneficiaries, they have equitable title, I mean, they get all the income. And so through something called an assignment of beneficiary, you never have to change the legal title. And many places where they have what they call real estate taxes or county, it's normally the county, I think. If you have a land trust, you never have to transfer, you don't never have to really change title. You can just change the beneficiaries through something called an assignment of beneficiary, meaning that you can avoid the property being reassessed in the future. So normally when you real estate change hand, you bought it 30 years ago, and then you go to transfer it to your brother, 30 years later, they may reassess it based on the value of the transfer, and then he has to pay more property taxes on it. With a land trust, you can avoid all of that and then transfer it to your brother through something called an assignment of beneficiary. You can use it for, assignment of beneficiary. So that's something that's not commonly used or discussed, but more and more professionals are starting to, advise it to people. It was something that very wealthy people did. In real estate, there's something called a real estate investment trust. That word trust pops back up again. That's a lot of people invest in real estate that way. I call an LLC a poor man's version of a real estate investment trust. It tends to take a lot of money to form a real estate investment trust, whereas it doesn't take much to form an LLC. So I think an LLC is like a poor man's version of a real estate investment trust. Any questions so far on the choices of entities?
I have a general question because as we know, there's a lot of listeners who they may have some sort of small businesses and online entities and the like. So, for example, if someone has a store online, be it Shopify, Amazon, Etsy, etc., which type of these companies will be best for them as far as taxes and as far as liability protection?
Once more, for any specific person, you should talk to an attorney. I'm required to say these type of statements. So I'm not telling a specific person what to do. I'm talking generally. And I'm not giving legal advice to a specific person. And I'm not giving tax advice to a specific person. And so with that said, if someone, whatever reason, can't afford an attorney or don't want someone to cater something to their specific situation, as a general rule of thumb, LLC taxed as an S corporation, it can serve a lot of different interests. And now a person specific one, once more, I would encourage them to bounce it off a qualified professional that can advise them in those areas. But from a tax perspective, an S corporation tends to make a lot of sense for most small business owners. Now, I said the LLC because I find with a lot of smaller business owners, they don't put on their calendar their annual meetings. They can go 7 or 8 years, and once they form it, open up the bank account, they may do the tax returns each year, but they forget to do those resolutions and keep up with their corporate books. And then if something is sort of like insurance, you think you got away with it and you save money by not doing these things or getting qualified people to help you. And at the time that you need it, then you go, man, I wish I would have paid somebody to help me with this. So it's like insurance. You may, go without insurance, But that day that you have an accident, and I know the religious positions on the insurance, so I'm not encouraging insurance. I'm just using it as an example in this country. So, the day that you have an accident and the money that you save, you may end up paying for it in one accident. That may happen 7 years later. And so that's how it is when you go with quality people to help you with these type of decisions, is that if it's done right, you may not never need it. But if it happens that one day, you wish that you would have paid the money to be, to have stuff done where it was tailored to you. And so anyway, to answer your question, is for many people, an LLC taxed as an S corporation tends to serve a lot of different people's needs.
Right.
Times that it won't. If a person has whatever they're selling, if it requires a professional license or something, they need to check once more in their state if an LLC can conduct that type of business. If they got some investors that are foreigners, that would make this not, apply to their situation because a foreigner can't own an S corporation.
Right. Now, as far as that answer, would that answer be the same whether the person was alone and or had partners?
Like the more specific their situation is,
Right.
it sometimes changes things. But since an LLC can have an unlimited number of members, as a general rule, it still would maybe apply that an LLC tax as an S corporation. An S corporation can only have up to 100, with a few exceptions for family members and stuff like this.
Right.
So it depends if it's under 100 owners that you're talking about.
Okay.
Yeah. That are not foreigners.
Right.
Yeah. Also, one thing some states, my state, for example, California, we have a gross receipt LLC tax that based on your gross receipts, it tax you. So sometimes some businesses could be a little bit more costly in my state, whereas if it was an S corporation, we don't have a gross receipt tax in California. So that'd be something that would need to be looked at on the state level. In that state, if they were conducting high, sales with an LLC, is there any special tax that would be applied to an LLC as if they went with another entity that would not? And so that would be one of the issues. Many states don't have that, but here in California, we do have it.
Gotcha. Now, with that being the case, now, I mean, are there some states that are better to start businesses in than others?
The answer is yeah, all states are not equal, but It depends on it. Like, I get a lot of people, like, when they come, hey, I want a Delaware corporation, Darwin. I'm like, okay, what's the reason you want a Delaware corporation? They got a little plumbing business. They're not going to get any investors. And they in California. It just means they're going to be filing in 2 states, reporting to 2 states. They're going to still have to register their business in California, pay. We have something called a franchise tax. And whether you make money or not, for the privilege of doing business in this golden, beautiful state and getting shade from our palm trees, you have to pay us $800. And that's whether you make $1 or not. And so some people try to get around that, and they say, I want a Delaware corporation. Right. Then they tell me, well, Microsoft is Delaware, Apple is Delaware, and that's true. Many publicly traded companies are Delaware corporations. And the reason is that one of the reasons is that if there's a class action by shareholders, Delaware tends to afford or lessens the rights of shareholders in class action lawsuits. So that's a benefit for a publicly traded company, that if all those owners decide to go against the corporation, and Delaware it has a little bit more favoritism towards the corporation as opposed to the class of shareholders. So if a person is not looking to be a publicly traded company, they may not get afforded that benefit. Delaware does have some really good, they only tax you on income from that you make in the state of Delaware. Right. Any of you guys ever been to Delaware or been through it?
Yeah, I've been through it. I'm from Jersey, so we've been through it.
I'm 15 minutes away from the border.
A lot.
Okay.
Many times.
Outside of a lot of corporations and buildings that house all these corporations, I mean, how many sales realistically someone going to do in Delaware? You get what I'm saying? It's like very low chance you're going to have income there.
Right.
Yeah, and so practically for many people, you know, they don't have to pay. They filed a report, but they don't have to allocate any of their income to Delaware because they probably didn't have any sales there. And no offense to Delaware, I think it's a really good state. I have formed a lot of corporations there, so I use New Mexico a lot now. I was using Wyoming a lot, and when this coronavirus came, I discovered something that I was not aware of with Delaware. I mean, with Wyoming. The people in Wyoming, you guys got a really good thing going with your corporate entities. And I was making a lot of recommendations for people to form. I help. There's some attorneys that I give advice to. There's some other people that do asset protection. They bounce certain things off me. And so I was like, guys, Delaware. During the pandemic, something came up.
Wait,
and
you
so
mean Wyoming?
I start now. I apologize, Wyoming.
Right.
Wyoming. Thank you. Yeah, that's a big difference. Thank you. So Wyoming's very cheap, $50, you know, annual fees, $50, beautiful.
Wow.
You can form it online, get it the same day. Also for someone like me that I want to turn a project around really fast. Here's the problem that I discovered. A colleague of mine formed a corporation for someone. That person didn't use the corporation. It was part of an asset protection strategy. They never used it. Fast forward, when Corona came, if you had a bank account, a business bank account as of February the 15th, 2018, you could qualify for Corona money. So they had a bank account, and so they wanted to get some money. So they wanted to use that corporation. Wyoming had I apologize. Wyoming had did something called an administrative dissolution because he did not file his taxes for, I think, 2 consecutive years. They closed out his entity. That entity could never be formed. It can be formed again, but it won't have that start date when it was formed, 2 years ago or 3 years ago in his case. So the problem with that is that he can use that entity to get the loan, or that his loan. This was a non-Muslim, by the way. And so after that, many of the smaller people I started businesses for, sometimes they're not up on their game and they go and file 3 years of tax returns at one time. And so my state, you can go 7 years or something. You're gonna have to pay $800 and catch up on all those $800, but they would reinstate you. Wyoming won't reinstate you. You got to start all over again. When I found that out, I said, no, because it's very likely that some people that I form it for, they're not going to be up on their, state filings every year, even though it's real cheap for $50. New Mexico, opposite. New Mexico, you file it, they don't require you pay $150 to form it, and you don't have to do anything else. If you don't do business in New Mexico, you don't have to do anything. You can go 10 years and never have to interact with them, and your company is still active. So I said, no brainer, same $50. I ran straight over to New Mexico, and they don't let you form it almost the same day, but about 3 to 4 days later, you end up with one. So
do I understand this correctly that these states, they're like Delaware, where they do not require you to have residency in the state to have a business there? Yeah.
When you most states don't require you to have residency in the state, but when you don't have an address in that state or an office, you have to get something called a registered agent, and there's a lot of companies that provide that service. Okay. So if you're in Tennessee and you form a New Mexico corporation and you don't have an address there, you don't have a human that you have a relationship that'll let you use an address, then there are professional services called a registered agent. And the purpose is that someone who sues you, they should not be trying to go all through the 50 states, go to Hawaii and go to the US possessions, go to Puerto Rico and Guam and all that to figure out where you at. So they just need to send the lawsuit to the registered agent, and then the registered agent is required to give it to you, and you consider served. So that's the main purpose of a registered agent, is to make it easy if someone needs to sue the business entity.
Okay.
Yeah. So the answer to your question, you don't have to have resident in the state, but you will need to have a registered agent. They range from anywhere from as low as $25 in some states or through some companies to as much as 160 some want to charge.
Right.
And then some of them will let you use their address for all other stuff so that you can get mail and everything else that's unrelated to a lawsuit. And others, they only, are only a registered agent.
Now, this is for all the states, Delaware and Wyoming, New Mexico included?
Most states, I haven't looked at all 50 states, but I would say
Okay.
most states, if you don't have an office there or a natural person that you can use and you don't live there, you have to pay a professional company or someone to be a registered agent.
To be a registered agent.
Yeah, that's standard. So anytime you form an entity in a state and you don't have a presence in that state, a physical presence, you normally have to get a registered agent, and mainly so that people don't have to figure out and waste money trying to figure out where to serve your lawsuit.
Gotcha.
Yeah. Good question. Thank you.
Okay.
Now, so we're going to move on a little bit with some of the other questions. The next question would be, what are reasons why you typically see businesses failing from your experience?
I'm gonna step back from failing. I'm gonna tell you one of the biggest reasons they never get started is that I have two young guys. They started a podcast. Both of them are highly successful in entertainment. They came together. They were so excited. This was one of my one of the individuals. He's in acting, and I had formed something called a loan out corporation for him. And a lot of actors have something they call a loan out corporation. So I formed one of those. He went on. We didn't interact. He came back to me, real excited. Wanted to introduce me to his business partner. So we met. Beautiful conversation. End up forming a corporation, or actually an LLC for them, so that they can do a podcast. They came out the gate hitting it. I was excited for them, and they going to monetize it over a piece of equipment, two pieces of equipment. They fell out with each other just as things are getting big, going to happen. And that brings me to my point why many businesses fail is because of one person is undervaluing the other person, misunderstandings, emotions. And so it's the human, they could have a real good business model. They can have investors, resources, but they fall out with each other and power tripping by one or what have you. So that to me is a large factor in businesses failing. Is I'm going to put it up under the owners, having misunderstandings, not getting along, or poor management. That's a huge factor. And for a lot of businesses don't even make it to the light of day. And if they do, this is part of the reason that they fall out with each other. And I have quite a few scenarios that I'm in the middle of now, because like these two guys, for example, I literally, I visualized two kids playing in the sandbox, and one of them said, "Give me my Tonka toy." Another one like, "Oh, I'm going to take my gun," and they stopped playing. Both of them unhappy, but no one's a big enough man to come back and say, "I'm sorry. You can use my mic, and you can use, my whatever." So anyway, whether it be restaurants, whether it be trucking businesses, whether it be whatever, that's a huge factor in failure.
What advice can you give entrepreneurs with little investment capital?
Okay, can I go back to one? This is a specific business. One of the number one reasons that restaurants fail, and many restaurants fail within the first 2 years, and then the next milestone for a restaurant is 5 years. Many restaurants fail within the first 2 to 3 years. Many of them start off underfunded, so they don't have enough capital when they start, and then as a lack of capital, they're supposed to report the sales taxes to the tax authorities. They start using the sales tax money as working capital. And it takes about 2 years or so for them to get audited. And then when they get audited, they get this really big sales tax bill, and some of the assets and equipment and stuff may even get, levied to take care of the sales tax bill, or they do a little quick scam and say under new management, so they can start a new sales tax account and claim that their cousin or somebody is operating. But that's a big factor. They get hit with that tax bill and then they go out of business, and they were already marginalized financially. And then when that tax bill hit them, the sales tax, that's the straw that broke the camel's back with them. And so they fell within the first 2 to 3 years. First reason that it started too underfunded. And then because of being underfunded, they stopped remitting the sales tax and then start using it as working capital, thinking that it's going to get better, and they keep getting in the hole.
But that answer is linked to the next question. What advice would you give for for entrepreneurs with little investment capital?
One of my suggestions is to encourage people to read the summary life of Don King, and the reason I suggested Don King is that he did something. He leveraged a little money to secure bigger money, and when he got out of prison, I'm summarizing, so this is not a documentary on his life story, but just summarizing it for business owners. So the Wu-Tang Clan, I think, is a really good group to study in terms of how to management vision, getting along. In some business schools, they actually study them. So a lot of times, small businesses and us as minorities, we think we need to look to the Bill Gates of the world and the Mark Zuckerbergs. In reality, Bill Gates is not a good example for most of us that's coming from certain zip codes. Most of us, our father doesn't know Ross Perot. Our father doesn't come out the gate and we get $40 million acquisition money and stuff. Our fathers are not, some people get painted as, that these little geniuses dropped out of school. That's the narrative that, society like to push. But when you start looking behind that narrative, you'll start finding that they had a lot of resources in their favor. And then we want to duplicate that. And we don't have the connections that his father had. We don't know that Bill Gates spent many of his summers in programming. He went to a very specialized school. They had high computers when nobody else had computers. He was part of a programming group. He had years of programming, and the little kids in his community. And so, but I hear people, Bill Gates, Steve Jobs, Mark Zuckerberg, and they seem to stagnate us looking at other people that are closer to us as examples that we can borrow from. And Don King is one of those examples. I know there's some people that are questionable that he may have taken money from boxers, but how he got started would directly be on point with answering someone who's got little capital and they want to start. And this is a summary. When Don got out of prison, most people know that Don went to prison for killing a man, in my understanding, with his bare hands. When he got out of prison, a lot of people like to say that the Italian mafia set him up and what have you. And it's like, why would they set him up to be better than him, better than them? None of them reached his level in boxing pretty much. He put about $1,700-1,800, from what I understand, into a very tight contract. So instead of going to start a whole boxing promotion company and putting the money trying to get venues, he put it in a really tight contract. Went over to Muhammad Ali and said, I'll pay you, if I'm not mistaken, it was $5 million he offered him. Muhammad Ali didn't have to do anything other than sign the contract. At that time, it was unheard of for a boxer to get $5 million, let alone a black boxer. Then he went over to Foreman and offered him $5 million, who was the champ. So Ali was the people champ. Foreman was the actual champ, and offered his camp $5 million. Once he got both of them to sign that contract, if he couldn't pull off the fight, they didn't have to do anything. If he can pull off the fight, he had something. He got two of the top boxers in the United States to under contract, but he needs $10 million to pay them and money for a venue. He shot that thing everywhere around the United States. Nobody, they laughed him. Don didn't give up. Don went to Africa and stroked the ego of an African leader that fronted him the money. And you know how Don talked, man. He used those big words. You're going to be the envy of Africa. You're going to have the whole world eye on it. And that leader went for it. Not only did he bankroll, he dropped the money to pay the fighters, he dropped the money for the venue, and the world had to go to Africa for that fight.
Rumble
That's
in
how
the
that
jungle.
fight ended up being on the soil. And then Dunn, if you notice, Dunn didn't care who won. He stepped right over his fighter to the next fight. So if you fought one of Dunn's fighters, you had to agree that Dunn would promote become that boxer's promoter. That's the only way you could fight one of his guys. So he didn't care who won. So they could not figure out how to get him out after Muhammad Ali and Foreman fight. They couldn't figure out how to get him out. Now, here's the lessons I want to pull from Dunn, and then I encourage people to look into it. One is that he used leverage. Two, he got outside investment capital. He didn't have the $10 million, but he made it an algebra equation. He lined up the X variables that didn't require money. So the money that he did have, he placed it into a good attorney to write him an airtight contract, and he knew he had something. He was a visionary. And then his contract was an innovation in boxing action. Then he went and got Muhammad Ali. That was just gift the gab, convince him. What did they have to lose? If this guy running his mouth can come up with $5 million, it's a big payday. If he couldn't, they keep their training camp going. Went over to Foreman, did the same thing. How much money did that require? Very little. Once he had that, he had something. It's just the people in the United States, they didn't realize that he had something. So he went to Africa, and it wasn't on how much money you're going to make. So in America, it's how much money you're going to make from the fight. So you're going into a fight where you're already in the hole of $10 million plus the cost of the venue. They looking at this. No fighter had never made that. So they just looking at the dollar. That was more of a respect for an African leader to place his country on the map and get them in the history. And they always would be in the history books for that fight. So it wasn't about money. So he got into the intellect of somebody that had the money. He got in their head to understand how they think, what was their motivation. And he ended up now, and that made him a multimillionaire today and a legend in the boxing world. So now to someone starting a business, can they get the variable? Can they get cash being the X variable that's unknown? Can they line up all the other ducks? Can they go politic? And we as Muslims, since many of us, we can't go get bank loans and stuff like this, the ones of us that sometimes trying to follow certain rules, is that we should collaborate with one another and invest with each other. And so that'd be one of my things, is that can they package it where they can open it and structure it so if they're looking to start a business, maybe they want to put $500 into forming an entity that they can use as the glue to take other investors. And as opposed to just going to launch the business, seeing if they can get other people to invest into it. That'll be one of my advices, is to work with other people, collaborate, try to do what Don did to get the money to be the X variable, and then you work out all the other parts of the equation.
Yeah, well,
And the next
collaboration.
one, I'm sorry, I want to say, and the other one, I just had a guy that ran up on me. Allah's blessed me to drive a certain high-end type of car, so I get a lot of people as a result of the car just randomly start conversations with me and ask me what I do. So when I answer what I do for a living, they jump into whatever going on in their life, and most of the time don't even ask me if I have time to discuss it. But a guy wants $11 million to launch an app. I'm sorry, he wants $3 million to launch an app. So I listened carefully to him. And then one of my suggestions when I listened, and he's an African-American male, he believes because of the color of his skin is the reason that he's not getting funding. And I challenged him to think, was it any other reasons other than the color of your skin that you're not getting funding? I saw a couple of reasons outside of him being an African-American male that he was not getting funding. And long as he believed that's the only reason, I don't think that he would solve those other, or he would resolve those other issues that's probably preventing him. But one of it, I thought $3 million was a lot of money for a guy that has never ran a company and that wants to be the CEO. I don't think he has a proper management team in place that would justify him to get an investment of $3 million coming out the gate. So that's like someone saying, I want to build a skyscraper, but they never flipped a single family home. I won't, talk someone out of their goal, but is it really realistic if you never flip the house for you to jump into doing skyscrapers? So I challenge him to figure out a way that he can scale the business down where he needs less capital. So that brings me to my point. Is it a way that they can scale the business down and start smaller and then grow organically and then move from there? So
what about well, let's talk about this. What is a nonprofit organization and how does it benefit a person to start one?
okay. Through the years, I have helped to form a lot of nonprofits. Uh, uh, Najeeb and I, we have a history together here in Los Angeles. Najeeb Al Anjelesi when I first converted to Islam, he was one of the brothers that was really instrumental in me learning, helping me to learn some of the key elements of the religion. I think in my opinion, Allah blessed me twice. One, to become Muslim. The other one is to become Muslim in the Pacific community that I became a Muslim in. We tend to go by the brand of Salafia. And so I thought that was a blessing to come in. And then Najeeb was one of those brothers that helped to orientate me. I came from a business side of the community at the time. And so that's how I ended up with the name Abu Corporate. I was always trying to figure out how to get a dollar. And so Najeeb once has worked with me in an office before. And I used to explain how a nonprofit can bring money into a community. And I think you can recall some of those conversations if I'm not mistaken.
I recall a lot of them. And in fact,
Okay.
we need to have a private conversation. Maybe I'll give you a call tomorrow because I need your insights with my nonprofit, the nonprofit that I formed. But that's another discussion. But the point is, yeah, I remember a lot of those conversations, and I don't want to go into the conversations. I'd rather you answer your question. But I remember when I was in Montgomery, Alabama, at the job site, in the break room, the news was on. They were talking about a nonprofit called Wounded Warriors. And it was one of those nonprofits that was raising millions of dollars. The CEO getting paid 125,000 a year. The news, the way that they were reporting about him, they called themselves exposing him because when he took over, he was an ambitious CEO, and he started doing things, business, annual business meetings and things of that nature that the news considered to be extravagant, to say the least. And to make a long story short, they highlighted him for a short period of time, then they just stopped because the things that he was doing, none of it was illegal.
So one of the things that I tell some of my clients, even if they got good jobs, they got good companies, I encourage people to form nonprofits. And it's not for me to charge the money. I think the nonprofit can be an investment instrument, and I'm going to define it. My definition of an investment instrument is anything that you put money in and it allows that money to get pregnant and it pays you more money than you put into it, it pays you that back. It yields you that back. With that said, many nonprofits can be started for under, $3,000 or so. And that's not counting the marketing, the time and energy to go into it. But they can produce you a salary of 50,000, or like I know a nonprofit that I conceptualized. I conceptualized for a member of the community. It was something they were passionate about. I came up with a concept. We put it together. I did the paperwork on it. It was probably about initial investment of about the state fees the filing fees and all that. So let's say it was in it at that time about 1,800, 2,000, let's say. that nonprofit has been generating probably more than $60,000 a year for a household. And we're going on probably 6-7 years now. So if it was a stock that you purchased for $2,000 and annually it generated you $60,000, people would be, saying you're like Warren Buffett. That would be considered an incredible stock. So that's because a nonprofit has the ability to do that. That's why I classify it as it also can be an investment instrument. Now, with that said, I'm going to put a condition on it. This individual, though, he's doing with this nonprofit, they're doing a lot of good, not only in the Muslim community, but they're doing a lot of good in the general population, and they focus on youth. And so they're actually making a difference in the community that's been recognized. And they put a lot of time in it, but they're getting paid to do something they're passionate about. Whereas before we started this nonprofit, they were doing something that they were not really in. And so, so if someone has a cause that they're genuinely interested in and they want to make a difference, there are a lot of other members in society that are willing to give you money. It's not free money. It's linked to, effort, action, and that you got to do stuff. But it's something that hopefully you're passionate about, or that you care so much about the cause. And then other people will pay you either to pick the trash up in our society that they're not willing to get their hands dirty, or they made a lot of money and they like to see this change in society. And so nonprofits allow people that got money or small money, sort of like crowdfunding, small units of money to be accumulate that can make a big change. So legally, a nonprofit it starts off similar to a for-profit company, except you normally follow the charters of a nonprofit, but it's articles of incorporation. But you got to, when you form it, you got to match the IRS guidelines. So a C corporation, you don't have to do that. You just form it at the state. Whereas when you form a nonprofit, you got to look at the state and you got to look at the IRS at the same time. And then sometimes you got to look at the state tax authorities. And so you have a nonprofit, and then you have what is called a 501c3 exempt nonprofit. A regular nonprofit just normally means that you started at the state level. You're doing some social good with it. You're not doing activities to try to get $1. However, people are not able to deduct on their taxes, donations and stuff they make. A 501c3 nonprofit means that if they donate money, that they can get a tax benefit on their tax return. And then the nonprofit has certain tax advantages that it has. In terms of forming a nonprofit, I'm going to use my state as a basis, and that's going to be pretty much almost similar to most parts of the country. In California, you need 3 officers. So you need a minimum of 4 people to form a nonprofit. In most states, a minimum of 4 people. You need, if you want to get paid, you start a nonprofit that you want to get paid from. That you want to work for the nonprofit, sit on the board, and get paid. The IRS requires 51% of the board cannot receive any compensation. So you're going to need 2 board members that are non-paid, and in order for you to get paid and sit on the board. Then you need, and I'm assuming if you're forming a nonprofit, you're going to be the CEO or whoever's forming it. I'm assuming that. Then you need a secretary and you need a treasurer. That secretary and treasurer, as long as they're not one of the board members, they can get paid once you get a budget. So that'll be the anatomy of your 4 individuals. You have 2 non-paid board members. You have, the founder, that one person, and they'll serve as a board member and the CEO. And then you have someone that can serve as secretary and treasurer. So that's your crew. That's all you need to get going. I encourage people to keep it simple in the beginning. If you got a whole entourage and you want to show up like MC Hammer, and that's how you want to form your nonprofit, I said, wait till you get your 501c3 exemption status. And then you can go start populating it and you can name, director of Mississippi, director of Alabama, director of Florida. You can add whatever officer positions you want. But if you keep it simple in the beginning, it betters the chance and to make it easier for you to get the approval. Once you have the approval, most people pat themselves on the back once they get the 501c exemption. they think they crossed the finish line. To me, that just started the race. You got to get funding. That's, to me, is the success of a nonprofit, is can you get funding? And so a lot of people get the 501c and they thought that that was the goal. That's just the means to get to the goal, which is the funding. So with that, there are about 7 buckets of monies for a nonprofit. There's private foundation grant money. There's about 123,000, give or take, foundations in the United States that fund 501c3 nonprofits. The one that I use when I give seminars to explain to people how to complete grants and how to submit, I use the Hewlett Packard, William and Flora Hewlett, which is the H part of HP Computer. They have a large endowment. They give out about, give or take, $800,000 annually. And they've been doing that for a long time. And I normally use that.
I'm sorry,
William and Flora Hewlett, Hewlett Computers,
yeah.
HP Computers. So William and Flora Hewlett, I normally have people go to that website and I walk them through it. And there's something that's called an LOI. If you're going to ask for a grant, it's sort of like the executive summary of a business plan. And so to write a full grant proposal, that takes resources. And most private foundations don't want you to waste your precious resources. So they use a document called an LOI. It's 2 to 5 pages. If you're starting to go around the 5, you're writing too much. If you're doing it at 1, you must be really concise with your wording. So normally it's going to be between 2 to 3 pages on average. But in that, and many of them make it a form now on their website. So you're literally answering these questions. You're creating a ruler that you're going to be measured by. You're saying who you're going to, like if they give you funding, you're telling them how much you want, what you're going to do with it, who you're going to help with it, who's going to be working with you to help whoever you're going to help, and how you're going to measure the success of your help. And you're basically going to answer that in the most concise ways possible. They're going to review it. And if they feel you, they're going to say, hey, send us a full grant proposal. What that means, you are in the money. That's when you want to go get a professional to help you write that grant proposal if you don't know how to do it yourself. The LOI, any person who can draft a love letter or a love email can write an LOI. If your LOI hits, that's saying we want to give you this money. So you're either going to confirm they desire when you send the grant proposal to give you the money, or you're going to talk yourself out the money, but you're in the money. And so that's a private foundation. So you use a grant proposal basically to end up with the ultimate money. And there's about 123,000, and they give about annually each year. They have about $600 million under management, and they require to give about 5% annually of the fair market value of their assets. That amount to probably over about $20 billion that goes to nonprofits, give or take. These numbers I have are a little dated, so things may have changed in the last 3 to 5 years, but it gives you a general notion of how much money is at stake. The next one is private corporate grants. So corporations give a lot of money to 501c3 nonprofits. It's almost like advertising money for them or endorsement money. So that amounts to about $14 billion a year. You don't have to do a full grant proposal. Sometimes it could be a phone call, it could be a letter, but they tend to give amounts under $10,000, $10,000 or less. So that's considered sometimes relatively small. I give you an example, Coca-Cola. You have Coca-Cola, the foundation. If you're talking about big givings, that's going to be the private foundation. You need to use a full grant. Then you got Coca-Cola, the for-profit corporation. If you had an event, you want them to sponsor something. If many times corporate grants, they want to know how you're going to let the community know that what they did. So you need to show on your website, you're going to get them a plug. Maybe you're going to put their name in the menu. Maybe you're going to talk about how many people that drink Coca-Cola is going to be there. And it may be products they give. It may be in kind goods, or it may be cold hard cash. But anyway, corporate grants is one bucket. Then you have government grants. I don't have a quantity. I don't have a dollar amount in terms of it, but it's significant enough. And that breaks down on the state level, the federal government level, and then sometimes government agencies. But it's a huge amount, but I just don't know the exact dollar amount. Then you have individuals such as us. We donate a lot of, as Americans, we donate, give or take, about $300 billion to nonprofits annually. About 40%, 42% or so goes towards religious causes. That'd be the tithes and stuff for churches that get counted to that number. But that remaining amount, many 501c3s, they end up getting that money. A specific example I want to use is when that earthquake happened earlier, before we went live, we were talking about Miami, my stay in Miami. We're talking about Haitian people, and one of the subject with thinking of the Haitian people. There's an example with nonprofits that come out when they had the earthquake, not the recent one, but the one, the first larger one. We as Americans, we donated over, if I'm not mistaken, we donated about $2 billion to, I'm not talking about the government, we as individuals. Within about 24-month period, we donated about $2 billion, $2.4 billion, somewhere around there. $1 billion went to the Red Cross. That other $1.4 billion, that went to a bunch of 501c3s. Much of it went to tribes, many of the NGOs and people that got it, much of it went to tribes that don't resemble us. So they packaged, there's one nonprofit, I'm not going to say the name, they got $32 million in a very short period of time. 32 million. It came in $10 increments over a period of about 3 weeks. And what did they do? They took images that the news had gathered, they repackaged it, posted on their website. They're going to send care package to the Haitians. Someone saw it that was a news reporter, but not very celebrity, but she retweeted it. She gave $10, retweeted it, that we should do something for the Haitians. And I gave $10 to this nonprofit. You guys should do the same. That kept getting, retweeted, Twitter or whatever. Anyway, most of the money came in $10 increments. Most of the ones that got the money, my understanding, not much has been done in Haiti with a lot of the money. And they packaged the people of color, pitched it back to America, and ended up with a lot of cash. There's a situation called that happened that's called Darfur in Rwanda. They say it was a genocide. And we're talking about a group of Africans versus Africans, dark complexion Africans, some was Muslim, some was not, turned against each other. In the aftermath of that, something like 60 Minutes, it wasn't 60 Minutes, but they ran this special, and they talked about the women of Darfur. A group of Caucasian women here, and I'm only illustrating this for a specific reason why I decided to name tribes. A group of Caucasian women here, they trying to figure out how to get their home-based nonprofit to get funding, and they get a eureka moment. They decide to become the champion of the women of Darfur. They claim that the women of Darfur was getting raped when they looked for firewood. So these women went to found some tin stoves in China that under direct sunlight would get hot enough to cook a steak. So they raised $60 million. It would be amazing if they spent 5 million, maybe 10 million, maybe 5 million on acquisition and logistics of getting those stoves. That remaining money, they never have to work again in life. They can salary it out, and there's nothing to force them to use that money in Darfur. For the women of Darfur. Mm-hmm. And they probably redirected that money to other communities. And so my challenge a lot of times for, minority tribes is that, was it anything that we could do to help the people of Haiti? That if you had funding. And so and that's one of the things with a nonprofit, you can leverage the call, you can leverage your calls to get money. You can leverage the victims of, the victims of any type of mass destruction, whether it be man-made, such as what's going on in Syria, Syria, or whether it be, something related to weather, which is happened in Hades and has happened again in Hades, or what happened in Japan. And but we're underrepresented in those type of ventures, and we don't secure a lot of funding. But there's about 300 billion each year that is given to nonprofits, and we don't tend to compete for that type of money. Anyway, any questions on what we talked about
Deke,
so far with nonprofits?
So Deke had a question on nonprofits, if I'm not mistaken, all right?
No, I do. With regards to that, what are some ways that the Masajid could better utilize their nonprofit status as relates to serving the community?
And this is this question that he's asking, Abu Corporate, I'm pretty sure. Well, I know you're familiar with it, just dealing with the community that we come out of, and me knowing that you put together packages for the community to be more self-sufficient. This is something that you've definitely dealt with in the past, and you definitely have some insights and some as it relates to that question, and Allah knows best.
All right. One of the things I thank you for the question. When I mentioned a lot of the funding, there's not a lot of funding. So a lot of times when they want to give funding to Muslim nonprofits, they want to try to do this interfaith thing. And there's normally a price tag, for if you take the bag of cash, that comes with some conditions. Now, in terms of the general population, I'll let you on the phone and you, whoever may be listening to it, in the United States of America, where I'm at, you're trying to raise money to help Muslims here. You think that's a really good sell to get donations in the United States?
No.
I don't think so. So either forming nonprofits that there are some things that our government has decided that it wants to focus on, like obesity, for example. I'm sorry, I'm on my iPad and a phone call came through, so I hope it's not persistent. There are certain things that the federal government has decided that is important to the nation. And so obesity is one of those things, trimming down America's waistline. And they said that obesity is going to cost the American population over $1 trillion. I don't remember when that's supposed to happen. That's not health, that's obesity. So does it matter your religion if you decide that you want to take it upon yourself to help the country out and be a little patriotic and trimming down America's waistline? And they saying that we got a bag of cash if you can come up with creative, innovative ways to do that. Does it matter if you're Muslim, if you atheist, if you Christian? Does that matter, who you are to do that? So sometime we can work together as teams, and instead of walking uphill, we can walk downhill. And what they're holding money up for already, we don't have to say it's a religious nonprofit, right? So maybe there's a satellite nonprofit that can compete for these type of monies, right? And a whole group of brothers can be organized. And so obesity, I had to write a couple of packages for it and stuff like this. In my research, I narrowed it down. This is just Darwin's or my Abu Corporate's take on it. I look for ways to sum things up. So obesity, I broke it down. You got the health aspect of it. So if someone's a good martial artist, why not form an after-school martial art program or martial art program that can answer it? If someone's good at personal trainer, there's money, to help with fitness in the United States. Then it's food, dietary. So, you can exercise all day, but if you don't change the way that you eat, you still may not, lose any weight. So for those of people, it may be growing certain food, pushing a healthy agenda, educating people on it, awareness. The next one is the psychological aspect of obesity. You can give someone a gym membership. You can give them a good diet, set them up with a dietitian, and then let his soldier, trip on him or ask for a cooler, and then he goes and venge out and blows his diet, stop going to the gym because he's down in the dumps because he's having family relationship problem. So and so there's a psychological component in our attachment or the emotional attachment to food. And then all those have subcategories. But looking at things, anything related to children, many things related to women, and shelter, homelessness, beautification of different communities. And so these type of nonprofits, they do a lot of good in society. Society saying we're willing to pay people to basically, come up with solutions and innovative ways to deal with these, issues that the government cannot address or don't have the budget to. And so, and those, you just happen to be a Muslim that's operating an after-school martial art program. It's not a program specifically for Muslims. That can help with trying to secure dollars and create jobs for a community. One of the things I would suggest, if it's going to be straight a religious nonprofit and it's trying to get the masjid, is to look for what is called social entrepreneur type programs. So there's something called social entrepreneurism. Is that term understood, or is it common enough at this stage that everybody know what that means, or should that be explained?
Social entrepreneurship I'm unfamiliar with that. Social entrepreneurship, you might want to explain that.
All right, you said, I'm sorry, the mic was acting up. You say you are familiar with social entrepreneurism?
No, I'm saying
or not?
I'm unaware. I've never heard social
Okay.
entrepreneurship.
All right. So there, I'm going to use a family, a three-member family: the father, the wife, the husband, the wife, and then their child. The husband is a for-profit company. The wife is a traditional nonprofit, and the child is the social entrepreneur. The husband only cares about maximizing profit. He cares about his shareholders. He cares about getting rich. He wants to add value, but he wants to get paid for that value that he adds. That's a traditional for-profit. How do you maximize owners' wealth, shareholders' wealth? And it's not concerned about the environment. And when it is, or it's concerned about social programs, only if it can help it to sell more of a service or goods. The mom she's the opposite. She has a loving heart. She wants to go help every homeless person. She wants to help every battered woman, every orphan child. And she wants to give everything away. She can't keep $1 in the bank account because she's giving it all out. She never does anything big because she's always asking for another dollar. As soon as she gets it, she runs out and buys a homeless person a plate. And so she's not able to build. She's not able to get infrastructure. She's not able to grow because her heart is just too generous. And so that's a traditional nonprofit. It's always in the position that it has to go to donors and ask them for money. And it doesn't do a lot of sustainable stuff. But it's giving out all the time. But every time it gives, it has to go and hit people up and say, hey, please donate. Please, give us so we can go give. The son, he comes out, he analyzes dad, and he says, you know what? I like how my dad makes money. And I love how my mom's care and give. I'm going to take the best of my dad and the best of my mom. That's a social entrepreneur. So the social entrepreneur, he followed his dad and learns how to make money, and he can hustle, grind, and start businesses and stuff. But he has the heart of his mother, has the mind of his father and the heart of his mother. So he sees the homeless, unlike his mother that wants to run out and go to McDonald's or whatever food place and take her $5 and buy a plate. The son, he saves his money, gets $100,000, or he rallies people up to donate one time, $100,000. He buys a food truck. He holds off and let the homeless people be hungry for 2 months, purchase a food truck, gets it up and running, markets sell food like any other for-profit, but he takes the majority of the profits and he uses it to buy food wholesale. He uses staff of the food truck to produce the food. So he's making the food at the cheapest price. And then every day he gives out a certain amount of food. He does more good than his mother. He has a food truck. He operates as a profit, keeps a certain amount that it can grow. And he now, every single day, he can keep feeding homeless people. And most of us, we don't just eat once and then that's satisfied and we need to eat tomorrow. He answered that problem that his mom could not do. So anyway, that's called social entrepreneurism. That's what I think many of the Muslim communities should move in that direction. Many of the people overseas that used to give us money. So here in America, many, particularly the African-American communities, they got sort of complacent going overseas, and the people overseas in the Middle East and stuff were basically sent money. Walaikum salam.
You guys can hear me?
Yes, we can hear you.
It continues streaming with you guys because it.
Yeah, it did. We were still on.
You
disappeared, but we kept going.
Yeah, it said my internet. It was a disruption in my internet.
I don't know if it was still live, but we were able to still be on the Zoom at least.
Okay. I mean,
it didn't interrupt as far as I am aware.
Well, okay, not bad. So without a doubt, let me see. Let me just check here.
It looked like it was still going because I checked at the same time it went out. I checked on my phone, and it looked like it was still going live.
Okay, well, I missed that whole little presentation on social entrepreneurship. But the bottom line is, for the sake of time, I'll just review that when this is all said and done, because it is saved directly to my channel.
So I think many of the many of our religious communities and Muslim communities here in the U.S., I think they should consider a social entrepreneur model, and those type of models are more sustainable. When you listen to the people overseas, when they talk about what type of projects that they want to fund, that's in essence what they say. They may not be using the same terminologies, but they are like to, instead of building big masjids and you don't have the money to operate them, they're saying that show us that you got some revenues that you can generate. We'll put some money down on helping you to generate revenues. So maybe build smaller masjids and then businesses within the communities, and then the members of the community as they work, and trade with those businesses, then you can gradually add, a larger masala or what have you. So I think social entrepreneurism would be a way to go. And then if we can start to have, like the Middle East, they have planned communities. If we can start planning, like if we know we're gonna, like Kalamis Masjid, I'm gonna use an example. When that was announced that they were gonna, the Salafi brothers were gonna get that masjid, maybe we should considering slowing down on rushing to get the masjid and think about the houses and stuff around it. And that you can have places you can rent. And so that's what I believe is that if we can move to a social entrepreneur model, like we got a lot of, like one of the projects I'm working on personally that I hope can benefit the Muslim community is that we got a lot of brothers that's looking for halal work. So you're getting a lot of brothers that are starting to go into trucking. So with the high school diploma and getting a Class A license, you got brothers now that can demand $60,000, $70,000 a year. So that's attracting a lot of people. Now, I got some clients of mine that are Muslims that are driving trucks. And some of them are paying as much as $75,000 for the truck a year by leasing it. So they're not a W-2 employee. So they want the feeling like they got their own thing. So they got to pay for it. They decided to lease a truck because, if you're trying to follow the rule, you've got a family of 6, all the money that you make, from your, hustle goes into taking care of your family. I'm going to change iPods out. My thing told me I'm getting low. Hard for you to save up the money to buy your own truck. Perfect opportunity for other brothers. You can buy a used semi truck, 18-wheeler, or you can buy the tractor parts. So the front of a semi truck is called a tractor. You can buy a used tractor anywhere from $60,000 to $70,000, 75, you know. So a one time, and the life of that truck will last about 5 years, give or take, it'll last about 5 years. So off of one investment of 75, 60 to 75, you can now generate, you know, about, you know, the truck, I apologize, I didn't say what the truck can generate. The tractor part of the truck, it can generate anywhere from, I say on the low side, $50,000 a year, and that's like not trying to do much, to as much as about $120,000 a year. And that's just the tractor part of the truck. And that's after you pay the drivers. That's profit. That's not gross. So those are, to me, are brilliant investments. That's what a community, you know, should maybe put proposals together. Show this is not Sadika, but maybe leveraging a community to get people to invest into it, and then say 20% is going to go towards, you know, for religious parts, but we're going to let the investor get a return on his investment because it's more than enough margin there. And if you put, I'm sorry.
No, I'm just thinking out loud how long we've been saying this thing. The people, their minds are somewhere else, man. They can't see this, sadly.
Yeah, you don't need everybody at one time to see it. Just those that do see it. So if you see it, I see it. We're enough to get it. We're enough to at least get it started. But that would be a perfect example. And so I'm gonna just run some numbers. I know of someone now that's actually one of my clients. They've been doing it for almost 15 years. They're paying about, give or take, about $70,000. If a group of brothers got together or a community bought that truck and for him to drive, and he's not paying a lease, and he just pays equal to what he's paying now. That'll benefit the community. So the community dropped $70,000 one time for the truck. In the first year, that 70 will be recouped. And then after that, 5 times 70, 350,000 that just been brought into a community. Time that by 5 trucks, that's some meaningful money that can make a difference. And then take that money and then put up a couple of little houses and stuff around it, buy some land and diversify the investment. You know, and so now you're in a situation where each dollar is creating another dollar. So like as the community is sending out, you know, I used to joke and say, I wish MC Hammer back, I would have met him, and this would have been my financial planning for MC Hammer, for those who can see. So Hammer was doing this. For every $1 he had coming in, he had 4 going out. And my advice would have been, Hammer this. So every time you make $4, you spend 1, you always have a surplus. So as a community, you know, you're in a position now, we have too much labor, too much talent. Brothers come in and out the community looking for jobs. They get out of jail looking for something, or just converted to Islam and had to give up something haram. And what can we do to help them? This would put us in positions that we can basically take advantage of that talent. Towards the South, if you look, like I believe in something, I like to use something called big data. It's when you look at large data sets and you look at it to try to predict future patterns or trends. So you're looking for things. You can use big data to explain the past. You can use it to help you to understand what's going on. But one of the things is that you can make predictions off of it. And so these are numbers that are in the Muslims' favors. Globally, we are the fastest growing religion in the world. In the United States, we're the fastest growing religion. Our members tend to have large families. So even if we're not growing, even if if the conversion rate to Islam slows down globally in the United States, we still have large families relative to other people. But with the conversion rate in Islam, to people coming into Islam, with our, what you call it, birth rate, we're the fastest growing religion in the United States. So they call the United States a Christian Judeo society. And the reason they say Christian Judeo, they said that the Jewish population is the second largest group. That has changed. So they say it's going to be a Christian Islamic society in the United States. We got a lot of people that are aging, getting older. we have a huge opportunity to do convalescent homes, and where we can basically take, not everybody's going to be able to make hijra. Not everybody want to. Not everybody's going to be physical. By taking over a convalescent home or forming one, that many of them have Social Security, they have pensions. That would create so many jobs, so many jobs. You need the sisters to take care of the sister side, brothers to take care of it. You need cooks. You need people to janitorial. So that'll be a position for everybody, that we would be able to create so many different jobs, matched out with the trucking. And we'll start creating self-sustainable. Then we designate, we need to eat. We need meat. So somebody become the what you call it, the person that cuts meat, butcher. So someone become the butcher. So that family then someone get designated as a dry cleaner. And we start getting the tools and equipment so that we can compete for our own dollars and the general population dollars. And so anyway, all of that gets summed up to social entrepreneurism. And in each area, it may be something different. And sorry, let me just step away 1 second and get some tissue. Another one is using technology. Like, for example, Facebook is a country. Whether people like it or not, Facebook is a lot of things, but you got countries like the United States with 320 million, give or take, strong. You got Canada that is about 36 million people, which is about the size of the state of California. Many European countries are under 10 million. Facebook is pushing over 1 billion. They have been instrumental in helping to overthrow certain governments. The reason I point that out, they have created this virtual space and got so many people there. Why can't we create one website for Sunni Muslims, or I'm gonna say Salafi, but I think some people are people that practice, the deen based on the first 3 generations, right? That understanding. Why can't we create one website and then have many sites up under it where we can start centralizing our resources? That to me seemed like a no-brainer. But each community, and then have little sub-sites up under it. We can create a marketplace where we talk about like these things that you guys are doing, which is awesome. And I can personally say the evolution of my brother Najeeb, when we first started, he was focused on salat and prayer, which is awesome. And people had a hard time tolerating me because because I would focus on mostly business issues. And so, it feels good, to talk about salat and other things that are directly related. But my logic was that I had to give up all my hustles. I had to give up all my hustles when I converted to Islam. And I try to figure out, like, how do we make $1? And everybody was so quick to tell me what I couldn't do, but nobody would tell me the one thing I could do. And so I felt that if I get punished for making my money in the wrong way, why there's a support system to help me make my money in the right way. And so there was a hadith, and you brothers on the phone, I'm assuming all of your students of knowledge, and I'm going to say you guys got the deen better than me. But there's a hadith that resonated with me when I first came in. If I paraphrase it, is that if we can envy, there be 2. The one that has knowledge that uses fi sabilillah, and the one that has money that spends it fi sabilillah. So I looked at it, I said to myself, well, the chances of me learning Arabic and memorizing enough hadiths, becoming a hafiz of Quran at this stage when I converted, it was probably low, and I'm being realistic with myself. But all this stuff I learned how to do business in America and doing all this stuff the wrong way, it gave me some insight in how to restructure stuff the right way. So I said, let me compete for this side on the money. And then if I can get enough, then I just hand it to people like Najeeb and let them go and, use it fi sabilillah, and I just focus on the money. But my point is, now I'm starting to see that the students of knowledge and the imams are also starting to think of the community in a broader sense, and not, just, to help us with our salats and line up in the line, but starting to look at some of these other issues that make up a community, which to me is a major progress from when I first came in and when I looked around. But summary of that answer would be social entrepreneurism And it could take the form of a food truck. It can take the form of what the Goodwill is doing. That's a form of social entrepreneurism, by the way, the Goodwill, that they get people to donate the clothing and products, and then they turn around and resell it and use that to keep building, getting a lot of buildings and stuff. And so social entrepreneurism and thought out communities where, like in my community, for example, and this is not to bash my community. This is not to bash my community. I've benefited so much through the years. But one of the things is that, there's no place for us to set after we leave the masjid. When we come out, there's nothing to keep us in the community. So if there was coffee I can get, a place I can sit down with my laptop, it would help me to stay for one, because a lot of my work, I don't need to be in my office, but I do need a place I can sit down with my laptop. So we can't even sleep in our masjid. So it's hard to stay in between salats. If you're tired, you can't even rest between the next salats. If you go to sleep, you gotta move on and maybe sleep in your car or something. And that's not conducive to get me to hang around the masjid longer between salats. If it was a little place that I can go have a cup of coffee, set up with my little laptop, it'll make life so much easier for me to do more of my salats at the masjid. There's no reason that the masjid can't profit off of that. I'll be even willing to pay to rent a room. I'll be willing to pay for internet. I would prefer to give it to a community of Muslims when I buy coffee and tea. That's easy money there, and it doesn't take much. But when we start to get our masjids, I think areas not so congested, like we're in an expensive neighborhood. So we're going to be, based on demographics, we're going to become our masjid is going to become a remote community because the rent is just going up too high. And when they got the masjid and they could purchase the property around it, nobody had that insight. So now Koreatown is moving towards our direction. They coming with bank. And this is what we're fighting for. The general population, when they wills and stuff, they inherit ownership of property and stuff. I'm not putting them high because they use interest and stuff. So that's not what I'm saying. But we're sitting there trying to pass on rental agreements. Oh, apartment getting ready to move up. We need someone to lock down on this apartment. We need to be moving outside of these congested cities to maybe rural areas where we get the land and start thinking out the communities, and that we build the houses around and rent them to each other. And there's a lot of remote income now. There's a lot of remote income. A trend is going on with the Kafirs now. This pandemic has been the impetus for a lot of people to work outside their offices. That trend is still happening. So you got people now that are getting Los Angeles income, but now are starting to move to Texas. They're getting New York income because they can remote it like we're doing right now. They're remote it in. So there's no reason that we got to be like trees rooted into these cities because we scared that we can't make $1 and that Allah won't bless us and make $1 and there's no barter and some other, more, less, and we don't have to compete with the Kafirs for rent and stuff. So anyway, these are the type of things that I think if we rethink our communities, we plan them out, there should be a gym for our females. We should chart, not a Sadaqah gym. They're willing to pay, bro. They're willing to pay membership. There's no reason that we cannot build a gym so that our sisters can go and keep their bodies in shape and stuff. And then yet, some of the brothers, and I have heard some complaints, they look at a slim chick on, what is this thing? TikTok or some TikTok. And then they look at this, or some sister passed down and and then their wife at home thinking like, oh yeah, this Kafir can go out and she can work out in the gym, she can exercise, she can do all this. You want me to stay home covered up? Why can't she have a gym to go to? And we can make money off of that. Brothers, a gym, coffee shops to sit and talk. But these are the type, I think, future communities that we start recycling our dollars. I heard once that the Jewish community is that they have the highest recycle rate of $1 in the United States. And at the time that I heard this figure, it says when they make $1 from a non-Jewish person, it goes through 28 times before it goes to another non-Jewish person. These numbers may be dated. The African-American community, this is not Muslim, this is just African-Americans. We 7 cents. We're not even a whole $1. 7 cents. There's a lot of reasons. The Jewish community, they got kosher. So they got the benefit that they are programmed not to eat anywhere unless it has a right symbol. So that keeps a lot of money within their community. They got Hebrew, they got Yiddish. We as Muslims, we got kosher, even though kosher is more broader defined for us than, we got halal, which is broader defined for us than kosher is for them. So for them, kosher means it has to be by a Jewish rabbi. It has to be prepared a certain way. Whereas with us, we can eat the food of the Christians if it's slaughtered right, and slaughtered right once more. And we can eat the food of the Jewish community, and of course we can eat the food of Muslims. But still, there's no reason that we should not figure out how to recycle dollars among ourselves.
Definitely agree. I don't see anybody. There's nobody that's requested to come in to the discussion with questions or anything of that nature. The link has been put in the chat area for those that want to. I'm assuming everybody's shy this evening. And we've been broadcasting or live streaming for 3 hours.
This has been 3 hours. Ooh. All right, so I want to do one thing before we move to wrap up. I'm gonna throw some suggestions out to you for some other topics, but these will be more instead of a Q&A or just talking off the questions. There's one thing that I've been looking at now is that many of us, we could have more than one family. And so let's say someone has 2 families. So they got partner, I'm gonna say family. Everybody knows what I'm saying when I said family, right? Everybody got that? Okay.
No, we with you.
Right.
We with you.
All right. So an individual has family 1, individual has family 2, and let's say individual is fortunate enough to have family 3, right? So family 1 is recognized under American law. Family 2 and 3 are not. How can you hold, whatever is entitled to family 2 and 3, how can you prevent them from being at the mercy of family 1? 1 is a will, possibly, but that brings some other issues. So trusts are really good instruments that we can use. There's ways that we can retrofit these American entities and their instruments to basically facilitate our Islamic objectives. So that's an area that I'm starting to try to move into. And it's not something I'm talking about like a business line that I'm doing, but looking for ways to make the Muslim life easier here so that we can sort of live within the framework of the US, but, follow what we need to do. So one of those things is that I think we should have more awareness of is how trust can be used to accomplish these things. So if the male in these 3 families that I gave the example, if he expires and returns to Allah, where does that leave family 2 and 3? Are they going to be at the mercy of the first, family, the matriarch of the first family? And what if they didn't fully get along, and that it was really the patriarch? The male that was holding it all together, and so these are some issues that these these Western instruments, they can be retrofitted to facilitate these objectives that we have, and without getting the male somehow foul of the law. As most of us know, in the U.S., they say you can only have one. You can only be married 1, but yet it's legal to be married to the same sex, but it is illegal to be married to more than 2 of the opposite sex, which, go figure. But my point is, these instruments can be used for that. The other one is that I used to do a lot of family law earlier in my career, so some brothers know that. So I get hit up sometime when people have misunderstandings. So normally it's on the female side that they sometimes want to run to the U.S. court system because sometimes I think they think it's more advantage they can get. But when they got married and came into the religion, it was following the rules of Islam to come into the marriage, but some reason to exit the marriage, it seems to be the Western system that is chosen. So one of the issues, how can you force it on the back end? The Western courts to enforce, because many of the brothers would probably not have married the sister if it was not based on the conditions of Islam. They would not have entered the marriage. And so now that it's been exited, how can that be enforced? So in the US, you know, if you're going to try to enforce Sharia law or something like that, you're probably going to have a disadvantage. They're going to try to give the children to the woman and everything because they're going to say you're oppressing her and blah, blah, blah. But there's something that's well established in the US is contracts. So they have a contract that actually the state gets involved in a couple's marriage called a prenup agreement. Is a way that these instruments can be retrofitted, that it puts all the elements that we need of Islam, that it governs the relationship so that on the back end, if the person wants to separate and they choose to run to the court and not go to the imam, you're not asking the judge then to enforce Sharia in the United States. You're asking him to enforce contract law, which they're familiar with, which is a prenup. So maybe if we can have some topics that's on some of these things, if you're interested or what have you, I'd love to come back and maybe go more in depth into how those can be facilitated or what have you. And those are some, I'm starting to see a lot of people, brothers, particularly brothers, where their Zolger separated and then they, you know, they're running to the US court system and they sort of getting beat up in the court system, you know? And so I think, and that's affecting we're talking about business and all these entities, you know, if most of your money is going to this, you know, because you're having some family misunderstanding, it makes it hard to be an entrepreneur. And then you get hit with an X amount of child support or something like this. It sounds good, Darwin, that LLC stuff, but you know, I'm dealing with some other realities. So anyway, maybe if these are some topics your group may be interested in, I would like to, you know, discuss those more in depth.
We definitely want to have
awesome.
you back because without a doubt, this 3 hours just wasn't sufficient. Because I actually had two more questions planned to ask, but because we don't hit the 3 hour mark, I want to cut it.
I got a couple more tax questions too I want to ask.
Right.
But at any rate, what I'll do, inshallah, is we'll coordinate and set up another setting, inshallah, and I'll work with you. Concerning some of your ideas and how to present them, inshallah.
All right, inshallah.
With that said, to the brothers and sisters that were watching, again, I always encourage the brothers and sisters to subscribe to the channel for obvious reasons, and make sure you hit the notification bell so whenever we're doing something, that you're automatically notified. Tomorrow night we have the extracted benefits. We'll be going over the hadith of Mu'adh ibn Jabal, the right of Allah tabaraka wa ta'ala upon his servants and the right of the servants upon Allah. That'll be at the same time, inshallah, 8:20. The live stream start at 8:20, inshallah. And the weeks that come after that, because of the time change, we're going to start much earlier, inshallah. My regular participants are all on Eastern Standard Time, so we could have begun at 7 o'clock, maybe even 6:40, something to this effect, and Allah knows best. So the point is, we definitely want to adjust. We're definitely going to adjust the time, inshallah, in that regard. With that, it's hoped that the brothers and sisters benefited from this discussion. Hopefully, brothers and sisters walk away with benefits, with ideas from that which they heard. Also, before signing out, I know the brother Abu Corporate does consulting. Maybe you can inform the people what your business is specific to and how they can get in contact with you, just in case somebody wants to contact you after this for whatever consulting purposes that they may have.
Oh, okay. I hope maybe I do it at another point. Right now, I mean, someone just naturally is referred to. The majority of my business comes from referrals, and at the moment, I have a backlog. and I do take on new clients, but I'm not really doing no advertising or marketing. It's majority of referral and knowing someone who knows me or something like that. So, but I hope it benefited people. But at a later point, I may put my information out there. But right now, I if someone know you or like you refer someone, I'll take on them. But I'm not really doing too much advertising at the moment.
Yeah, لا بأس إن شاء الله.
Okay.
Okay, so with that said, سبحانك اللهم وبحمدك أشهد أن لا إله إلا أنت أستغفرك وأتوب إليك. السلام عليكم ورحمة الله.